Well, good morning. This is an audio check. Now, before we get into this, my comment section and my text messages on my cell phone and email box and every form of communication that anyone could get to me, everyone was trying to let me know that the volume was too low yesterday. And I'm doing the same thing I did yesterday. Okay. I noticed that some of the individuals that left comments saying that the audio was too low, um, or that I was using a cheap microphone or whatever. Um, I actually have good equipment. To sometimes YouTube just doesn't want to communicate the way a streamer would like them to do. And I'm not doing anything different today. I went through the process of checking everything. I have the microphone literally almost clipping. There's a little gauge that shows how high the audio goes up as I speak, and and I'm at the last little line before it goes into the orange, and then it's in red, and then it starts clipping. Then it's really bad audio. So the compression and all of the things that YouTube does on its servers sometimes corrects any issues through the capture of live streaming. I've actually had this happen in some of the not live session, but lectures and videos I've made in the past, where the audio, even on my side when I would listen to it, would sound different than my original capture that's on my system. So I'm not doing anything to try to make it harder for you to listen to me. I'm not using substandard equipment. I have a pretty good amount of money in the stuff I'm using, and I don't know what else to do. So my volume's exactly what it's supposed to be. My microphone is working properly, and I don't know what else to tell you. Okay. So if you're sending me text messages, by the way, I don't ever really get to see them until later on. And generally, I block your phone number because you took it upon yourself to step into my private area of my life. And I know my phone number and my address and all those things are on the internet. Um, I'm not inviting you to send me text messages. So you can send me something one time, but I'll never see it again because you've crossed that line. It's kind of like the people that come to my door and knock on my door. I'd like to meet you and talk to you, ICT. Please don't do that. I'm not going to go out there and talk to you. I'm not going to shake your hand. I'm not going to do a selfie with you. I'm not that important. So anyway, today it's going to be a little bit more technical, but I promise it won't be too much, and it won't be a long session. Okay. Um, I have an eye appointment tomorrow, just so you guys know, for scheduling purposes. We will be doing an afternoon lecture. So we'll be doing a PM session and some rule-based ideas for you to look at the market during that time, Caleb. And so I won't be here tomorrow morning session, but we'll start the stream at 1:30 p.m. Eastern time tomorrow. So Wednesday's session will be an afternoon session. And then Thursday we'll be back to a morning session. And Friday will be a morning session as well. Okay. So one of the things I want you to understand, Caleb, is when you're doing your journaling and your logging, which is what you're going to be primarily doing for the full month of August. Okay, you're not trying to push any buttons, you're not trying to demo trade, you're not trying to do anything specific about entering the market, but you're just collecting data, collecting information, and you're being organized. So that way it's training and activating your reticular activating system. Okay, that means when you see a car that you just bought, it seems like everybody else bought the same car. It's only because it's now meaningful to you. So the things I introduced yesterday, I kind of like want to give you the rule-based idea on what it is, very specific, and I have to clarify a few things because it was live streamed yesterday, and I said a couple things incorrectly after listening to the playback. And a couple of you actually reached out to me in email and questioned me about what I meant about certain areas of my dialogue. And I realized I didn't say something correctly. And for instance, it was me referring to the second stage of reaccumulation. I miscalled it second stage redistribution. Well, that's for a market maker sell model. But because I'm out here without a script, I'm not following cue cards, I'm not reading a teleprompter. I'm just going on my own steam and just what I see at the time. So I'm going to invariably make a mistake of miscalling something. It's not intentional. It's not to confuse you or anything. Um, but I'm human. So I'm not AI like some of you actually think I am. I have frailties and faults just like any one of you. So if I'm out here in front of the world doing it live, I'm going to make a mistake, say something incorrectly. I'm going to, you know, have no way of editing that out and make it more palatable for a first time viewer to listen to it and not have any distractions by something I did as a human being. And that's why I prefer to always to do pre-recorded lectures, because my obsessive compulsiveness wouldn't let me do the live streaming. Um, but I've spent a lot of time in the last year or so just getting over a lot of that stuff. And I'm in my 50s, so I'm trying to take things a little bit easier. I make things too personal when it don't need to be. So anyway, I introduced some things yesterday visually. I talked about what the market was going to do, why it should behave a specific way, and how you should be comfortable sitting in front of the charts and observing and getting used to doing that initially, and not trying to force yourself into trying to pick a direction so you can impress dad, not try to tell me what you think is going to happen beforehand so that way you can tell dad, hey, I did that right. Remove the right and wrong right now. Just get that out of your head. You've already sent me text messages telling me what you think is going to happen. Okay. Now, for the purposes for everyone here to know what he sent me, I'm not going to be able to show you the screen, but I'm going to read. I didn't actually read it word by word, but I want you to see what Caleb's expectations are for today. And this is without any prodding or coaxing on my part. Um, at 7:33 a.m., he sends me a chart that I really don't understand what he's showing me. So that's the point of today's lesson. I want your charts to be organized. I want it to be very specific in capturing what I want to see, so that way we can measure your progress going forward. And that way your charts will look uniform every day. And then at the end of the week, we'll sit down with a weekly recap, and that'll be your first video. Everybody's asking for your YouTube channel right now. There's nothing on it yet. Okay, so hopefully this weekend we'll have something where we sit down together, maybe over a Zoom call, and we'll review what you've done and how to go into next week as well. So it's kind of like over the shoulder approach to ICT, grooming and teaching his son, mentoring him, and that way you get to be a part of that experience. So, but he says at 7:34, he says he wants to see it take the swing low, then go long, take out the relative equal highs, and then reminds me, don't forget to do an audio check. Listen, the audio is going to be what the audio is going to be. Okay, so don't send me any messages. And for the assets to send it really rudely in the comment section, I never will see a comment from you ever again. So I make you invisible to the channel. So you think you're leaving messages and posts on my channel, but I'm never seeing that again. So if you're rude, I got no time for you. So anyway, Caleb thinks that there's going to be a rally higher today. And that's not to say that that's right or wrong, because I purposely have kept myself away from looking at the charts. So I'm sitting down with you right now, with the exception of just loading TradingView and opening up the quadrants that are on the screen now, the 4 charts. There's should be a chart in the upper left-hand corner, right up here. That's my 15-minute time frame chart. Every chart here is naked. That means I have absolutely 0 annotations on them. And this is what it's going to be like for you if you have a job, or if you're in university, or if you're sleeping and you're coming back to the marketplace to kind of learn what has happened, to train your eye. Okay. For the folks that are here that are just chomping at the bit to watch me push buttons and enter trades, that's not today. The reason why is because I'm teaching my son on how to start, and anybody else wants to listen. This is the proper way of doing it. I've already proved yesterday that I can call it minute by minute and tell you where it's going to go. If you didn't see that, go back and listen to it again. But we're going to go back into yesterday's price action and show how, if you can't be there live, okay, say you can't watch me live either because your boss is over your shoulder constantly hovering over top of you and you just don't want to risk losing your job. Please don't do that. Don't lose your job. because you need that right now until you get to the point where you can replace it with your investments and then eventually double it and then have 2 years of living salary and then you can quit your job. But until then, we can't talk about quitting jobs. So the upper left hand corner is my 15-minute time frame. The lower left hand corner is a 5-minute chart. And then the upper right hand corner is a 1-minute chart. And for teaching purposes, and to answer a few questions that came up from my private mentorship students, how to hold on to a trade and or how to look for additional entries if you miss the ideal one that would be on the 1-minute chart. So I'm going to give you a little bit of lesson on the price delivery continuum theory, which is where we go through all of the time frames. And all the time frames, as I mentioned yesterday, this is it. I'm not using anything higher than a 15-minute time frame because it's intraday trading. You don't need a daily chart. You don't need an hourly chart. You don't need a 30-minute chart. You don't need anything above a 15-minute time frame because everyone's clock. I don't care if you're from Switzerland, Uganda, New Zealand. By the way, did I read something correctly? New Zealand, did you just pass a bill or a law that says that they can arrest you if you've not received the arm ticket from Mr. 19? And I can't say everything exactly as I want, but it seems like I read something that said that New Zealand lawmakers have passed a law stating that they can arrest you if you don't have the thing that should have been introduced as a remedy for Mr. 19. Wow, and then forcibly give it to you. Send me an email if you have any information on that and title it New Zealand, and that way I'll look for it because I get too many emails. I can't read everybody's email. But wherever you're from, you're all going to have the same face on a clock, and everybody has a 7 o'clock in the morning. Everyone has a 8 o'clock in the morning, and everybody has a 9 o'clock in the morning. And as long as that time is set to New York local time, every one of us are going to be on the same page every single market day. We're all going to be expecting the same thing. There's no way for me, as the educator here, to have out. I don't have a way of saying, well, this is what I really meant and it did this, and that. It either works or it doesn't, right? And yeah, that's the litmus test. It either works or it doesn't. It either holds up, it stands the test of time, or it doesn't. How can you prove that to yourself, to trust it? That's the important factor, and this is the part that most traders, when they're developing themselves, they rush through this. And this is such an essential part that I can't stress it enough. And I've done it a lot in lectures and teachings and all of my mentor videos, is focused on slowing you down in the initial stages because you're too quick to run out there and try to make money. And you don't know what you're supposed to know. You don't even know what it is that you should know and what you should avoid doing. And I'm going to cover a little bit of that today. Also, how to organize your charts. And then I'm going to show you what you need to be doing as homework for the rest of the day because we're only going to be here till around 9 o'clock. Hopefully. That's my plan, at least, right? So that way you can go in and start looking for very specific things that your eye will jump to initially. Doesn't mean that that's going to be your model. Doesn't mean that's going to be your entry technique that you live by and make all your money from. It just means that that's your first one. And it's an invitation for your personal interest, what you gravitate to initially, wherever you are in your development as a trader and what you've been accustomed to seeing from my content. I have to allow that part. You have to give yourself permission to have that part as well. Because if I force you into, we're only going to use breakers, we're only going to use order blocks, we're only going to use fair value gaps, it's going to alienate a large segment of you and you will be left behind in your development. And that's not proper learning. That's not a hallmark or a signature of a good teacher. So I have to make allowance for you to bring your own personality to this. And you're going to see the benefits of that because for some of you, you've been trying to lock yourself into one trick pony ICT concepts because either I've done a video or I've done a trade or I've recorded something or I said something that really resonated with you and you think because it sounded cool, you want to be tactical in your trading instead of technically linked to your personality, it is going to be easier for you to see how you've held yourself back by trying to force yourself into a mold that nobody asked you to do. The proper learning is for you to come into this and say, okay, there's lots of things in this candy store I can have. Which one do I want to work with first? It doesn't mean it has to be my favorite, but I have to start somewhere. So I leave that up to you. And it'll make much more sense when we get into the charts and the technical aspects. But initially, I want to give you the protocol that you go through every single day when you sit down in front of the charts, whether you're doing it live or if it's after the fact and you come home from university, come home from school, if you wake up and now you're going to have time to do it, you haven't made the changes in your life to allow yourself to actually be in front of the charts there live, or you're working. Let's just be real. Okay, you may not be able to do what we're doing right here live. Maybe you can't see me doing live streams when I'm doing them and having the benefit of borrowing my experience. So what do you do with that information? How do you journal? How do you log what it is that you should be observing and studying each day? And then referring back to that same information on an individual day-by-day basis on the weekend, whether it be a Saturday or a Sunday. When I used to do Twitter spaces, I would talk about how this is our day to kind of like ground ourselves. The markets are not trading unless you trade crypto and you're an idiot and you think that that's going to be real money in the future. All those things put aside, that is the day where we rest. We don't try to trade. We don't try to formulate any kind of hardline ideas. We go back and refer to what decisions we made, what actions we took, and or actions that we should have but didn't, and identify opportunities that we weren't able to see then, and then encourage ourselves through journaling saying, these are the things I did right, and these are new opportunities for me to investigate and look into, because this was something I didn't have the pleasure or the luxury of understanding or identifying at the time. You see what I did there? I took something that every one of us is going to have happen to us. Okay, there's a uh, opportunity for us to see what we could have done better. Now, if you're on social media or you invite other people, usually people that are an idiot, they don't know how to trade, they're toxic, they work at Jiffy Lube, they ain't got a raise, and they're probably on the verge of getting fired, you're going to listen to those individuals give you insight or opinions in your comment section, or they're going to comment to you in a live chat via someone else's live stream. If you make yourself available, okay, toxic people are going to give you their opinion unsolicited, and they're idiots. You don't want to listen to an idiot. The village idiot mentality is in every segment, in every community of trading. There's a whole bunch of them. There's a whole tribe of them. Okay. And you should not care what anybody else thinks. And if someone takes the time to congratulate you or say, well done, you need to dismiss that as well, because you're not trying to fuel ego. You're not trying to allow anyone to influence you negatively either. But that same element needs to occur in your journaling, which means you have to filter out all of the toxicity that you're invariably going to reach into and say, I didn't do that right. That was stupid of me. I should have saw that so-and-so forming in the chart. Or I saw it, but I ignored it because I wanted to be right. And then you feel compelled to, you think journaling is a beat up session. Like you're giving yourself an ass chilling. You're not trying to parent yourself. You're not trying to be dad. You're not trying to be mom, overbearing, correcting you and punishing you. What you're trying to be is the best coach for someone that you love. If you're trying to coach someone that you genuinely love and you don't want to break the spirit of, and you want to encourage that person, you should love yourself just as much as you love your spouse or your children. You have to have some measure of respect for yourself. And tearing yourself a new ass in a journal is not going to help you get better. You're not trying to play a drill sergeant. We mentioned this yesterday as an analogy. When you go through boot camp, they're tearing these individuals down mentally and physically and to the breaking point. And then they're shaping them up into a sword. Okay, you're going to be a Marine. You're going to be a machine. You're going to be a soldier of fortune. You're going to go out there and rip people's hearts out and eat it before they die. They're trying to turn them into an animal for war purposes. That's not what you're doing in a journal. Okay, you're not trying to mutate yourself into some crazy Wolverine. You're literally coaching yourself and you're encouraging yourself in any opportunity where someone else could, and yourself as well, could take something out of context and say, this is a perfect opportunity for me to dump on myself and spend too much time dwelling on a negative thought or a negative reaction or an inability to respond or react to an opportunity and frame it and encapsulate it with toxicity. You don't want to do those things in your journal. Now, for people that are idiots, they're going to say, well, you're just sugarcoating it, okay, and it's a waste of time. Journaling is a waste of time. I promise you, these people are not making money. These people do not have a trade. They're not consistent, and they're just absolutely miserable cretins. You need to keep all that junk and filth out of your mind, out of your circle of influence. That's why social media is a cancer. This is my only mode of social media. I am not on Instagram. I'm not active on Twitter. I am not doing anything else. I'm not in a Discord. I'm not running any kind of social media where people can engage with me. Hey, how you doing? It's not how that works. My private mentorship, we have a space. Okay? We have a space where we communicate. When I want to make something available to them, I talk to them. That's it. And it's at my time. It's at my, I don't schedule anything. It's just when you see me, I appear and that's it. Outside of YouTube, this very YouTube channel, there's no other ICT experience. And when I mentioned that I was never going to do a paid mentorship, I had people leaving comments yesterday saying, you said you was never going to do a mentorship. Right, for money. I'm not asking for payments. You're not sending me any money here. You're watching because you want to watch or you don't want to watch. So you have to manage a lot of people's personalities if you allow them to have any interaction with you. So the best thing you can do, if you're really going to make an attempt to do it well, is what I told my son. I allowed him to be amongst my private mentorship students. He's among them right now. But I've also told him, don't talk to any of them. And don't think that it's rude. Don't think that you're trying to be pompous or arrogant, because these individuals are going to try to warm up to you. And I have leakers in my groups. They're there. Okay. So I told them, don't even listen to it. They're gonna blow smoke up your ass. They're gonna try to befriend you. They're gonna say whatever they want. Or some of them might take a shot and say, hey, look, your dad's not on the leaderboard of Robin's Cup. He's a fraud. And what are you gonna say about that? Well, they won't have the balls to do that because then I'll broom them out of the mentorship. But the point is this: don't allow toxic people or anyone to fluff you up. And you need to do the same thing in your journal. It doesn't mean you can't congratulate yourself and cheerlead yourself when you do it right. Just don't lay it on thick where you think you're, the bee's knees, if you will, meaning that you're really a hot shot or better than you really are. So you have to be very, very balanced, but you're leaning heavily on coaching, encouraging. Yeah, you may have not observed a specific function in price delivery, and it just happened to be probably the biggest run of the day. And you, in your infancy and your understanding, you don't see those things forming yet because you haven't had an experience doing these very things I'm going to show you today, and then studying it and looking at old price moves. This is exactly what you need and must do. You will not be consistent. You will not be consistently profitable. You will not be comfortable waiting for setups until you've done this part. Now, I'm forcing Caleb to do this for a month because I want to see that, number one, he can stick to the process of doing it over and over again. I don't want to receive texts from him saying what he thinks is going to happen. I don't care about his opinion, and it's not appropriate for him to have that understanding yet anyway. He thinks that he should. He thinks that that's going to be a measuring stick so dad can feel like, okay, my son's doing his part. No, I'm going to know you're doing your part by what I'm going to outline today. And then this weekend, when we see it together, I'll know if you've been doing it or not, because you can't make that up. It's something you have to journal. It's something you have to go through the process of studying the charts. You can't fake that. You can't watch 10 minutes of my video like my son Cameron did and said, yeah, I was watching your videos, Dad, and so and so and so. Okay. Then I asked him something else I said in the video, and he had no idea what I was talking about. Because I know what he did. He skimmed through the video, listened for a couple buzzwords, and he fell into the same click a lot of people do on the internet. They want to talk with the language, but they have no understanding. But they'll use market replay to teach my stuff. That doesn't make any sense. You don't want to fake it. You want to be able to do it genuinely, and you want to have a genuine mentorship experience. Well, your part of this, your personal contribution in initial stages, is what this is all about today. Okay, so Yesterday, I talked about the process of not going above a 15-minute time frame. And I know some of you that have a higher time frame affinity for like a daily chart, weekly chart, whatnot, that probably feels very uncomfortable hearing that. And I've said this before. Um, you don't need all those time frames. Now, when you have a model that you're risking money behind, it's important to refer to those things. But right now, the only thing you're trying to do is get familiar with reading price action and getting over that fear of missing moves and fear of not knowing. The fear of not knowing what's going to happen next, it's an enormous sense of, well, it's like a barrier. You feel like you can't break through this invisible force field of, I wish I could know what it's going to do next. Because if I could just do that, then I could be profitable. And I'm telling you, that's not true. That's not true. But it has a necessary role in your overall development, and it needs to be the first thing. Where's the market likely to move directionally? Where's it going to gravitate to? And what time usually will these moves form? I introduced a very generic form of that yesterday. It's not complicated, and we're going to go through the rules very, very specific, and it's not a lot of them. It's not a whole lot of moving parts. And I'm going to clarify what I meant yesterday prior to 7 o'clock in the morning and what you're specifically looking for. Because I got a question from one of my private mentorship students, and I went back and listened to it. I was like, oh, yeah, I can see how that causes confusion. So I'm going to address that as well. I apologize if I confuse a little bit of some of the references to time around that 7 o'clock in the morning, because it does sound like I say, um, look for it before 7 a.m. And then later on, I say, you don't want to look before 7 a.m. So I'm going to clarify what I really meant there. And like I said, I'm not using a script. I don't have any kind of bullet points to go by. I know what I want to talk about, but because I was watching Price Action Live, my attention was on that as well as talking about what it is I wanted to cover. But yesterday was a casual lesson. This is a little bit more specific. So I have lots of charts available to me in hardware on screens that are off right now in front of me. I'm only physically working with a laptop computer. Most of you only have like a tablet or a singular computer screen or a laptop. Okay, and you can do everything from that. Okay, I would counsel you not to try to put your faith in using just a smartphone. Okay, if there's something you're observing and studying on the, on the move, like you're at work and you're getting a bathroom break, or if you're on lunch break and you want to look at the market through your phone, I don't have any qualms against that. But if you're going to try to make an attempt to learn how to do this well and consistently, you need to have something larger than your smartphone. Okay. And I don't mean the one phone like my son Cody has. He opens it up and unfolds and it's a bigger screen. That's still not enough. Okay. You have to have a laptop at minimum. Okay. About 15 inches, minimum surface space. You may not have a trading view subscription that allows you to do some of the things that I'm going to refer to today. You do not need a sub 1 minute time frame, but I'm going to show you, for the people that do have that, how to integrate that into this. Okay, I mentioned it in passing yesterday, so now I'm going to give you the rules and how it looks, what it looks like rather, in the price runs from yesterday, and how to study today, because I won't be with you after the opening bell at 9:30 Eastern time. And also the reason why I want to keep this short is because I have not been doing a lot of talking, and yesterday, a little over 2 hours, I got a little hoarse yesterday, so I want to make sure I can preserve my voice. I don't want to come to you tomorrow and say I can't talk. I lost my voice. As much as some of you guys really want to hear me say I lost my voice. So I'd probably still sit out here and type over the chart and without having to say anything, and still do the same thing. But people that don't know English, they'll send me hate mail saying, I can't read what you're saying. Why don't you have subtitles? Because I'm not speaking. It's all being typed out. So your chart, if you have the ability, put all four charts up on the screen like this. Your upper left is 15-minute time frame, lower left is 5 minute, upper right is 1 minute. And if you do have the ability to look at anything less than 1 minute, you can put a 15-second chart. Not that you need it, but you're going to find out today that it is very, very informative for seeing what price is doing underneath these 1 minute candlesticks that you never really are aware of usually, or you probably didn't even think of it, okay, prior to investigating and studying it, because there's a lot of things that you would see on any other time frame occurring on that 15-second chart. And it's very forgiving. So as if you missed a move and you missed an entry, the 15-second allows me to get into a move if I missed my ideal fair value gap, or if I have a limit order and I have the order sitting inside of a level that I feel pretty confident that it's going to trade to. Sometimes I've had it, and if you watch some of my recorded sessions before, you can see where I have had limit orders where it goes up and touches the limit order, but doesn't go above it for the spread. And I've had one instance where it did technically go above, and the spread should have afforded me the fill, but it did not fill me. Guess what that means? That's the real world. That's what's going to happen to you. When you start trading, you're going to have limit orders that don't get filled because we're using such a degree of precision. That is a welcome struggle. That's a challenge that I enjoy having. And you're going to learn to have that mindset as well. Whereas right now, if you don't have a whole degree of importance placed around precision, um, when you don't get your fill on a thing, it's it's struggling point for you to wrestle with. Why did that thing take off without me? I'm never going to get another move. This is the only move I'm ever going to capture, and I missed it. That's what you think. That's what you feel. But me and my students that have done these things for years and years now, we're comfortable with, well, I was trying to be so perfect and precise about where I wanted to get in at so I can have a very small stop, excuse me, very, very small stop loss. It didn't fill me and it started running away. So I didn't get my best fill. We don't get upset about that. We're not cussing at the screen. Oh, you so and so's, you didn't give me my fill. Okay, that is an expression, don't be a dick for a tick. Um, if you're trying to be very, very precise about your fills and your entries, um, and you don't give yourself flexibility and permission to see it not fill sometimes, you're going to have a real hard time in the early stages of order placement and learning how to trade entries, because you're going to be demanding perfection, and demanding perfection is an invitation for frustration and regret and struggle, and it's going to make your learning process a whole lot harder and longer. You don't want that. So a 15-second chart, just I'm going to say this and then we'll get into the business of the 15, 5, and 1. The advantages of a 15-second chart is that I can get into a price run that I missed on a 1-minute chart, a 5-minute chart, or a 15-minute chart, or any other time frame that I may be looking at. But for the rules that I'm placing on you, Caleb, these are the only time frames until I tell you otherwise. You're not looking at anything else. So don't send me a daily chart. Don't send me an hourly chart. Don't even ask me questions about any other time frame ever until I introduce some other reason for you to look at another time frame. Because this universe right here, okay, this whole solar system of price action is all you need. You don't need anything else. You literally need nothing else but this. I mean, truth be told, I said this before, I don't even need a chart. I don't need a chart to trade. But to communicate what it is I know that I'm not going to teach, I use charts to kind of bridge the gap. So it's a very effective medium. To prove that it's your task to see what I'm saying is valid or not. So y'all have this entire month to walk forward and see what it is I'm talking about, whether it works or not. You all will be able to see if it's based on fluff or if it's really valid. I walked you through it yesterday live over a 1-minute chart. Every fluctuation, telling you what was going to happen. There's still a huge opportunity for you as the person in the driver's seat of determining what it is you're going to do with this information. Because there's, as you're going to see today, there's a lot of that in your disposal. You have a lot of input that you're going to bring to this. And I'm not asking you to send me email saying, okay, I watched this and this is what I'm choosing to do. Like I'm going to sit down and say, well, that's a good decision of what you're focused on. And I think this is a great, I don't have time to do that. There's too many of you that always try to reach out to me, and I physically don't have the time to respond to everyone. And that makes a lot of you upset, like I'm ignoring you specifically. No, I'm trying to ignore all of you. I've been trying to have a normal life, okay, and not have ICTism all the time. But the 15-second sense just simply gives you more opportunities to get into a move that's underway. That's really all I'm saying. Or to dial down and reduce the risk and the exposure of a stop loss that would otherwise probably require much more handles or pips if you're referring to Forex. It can be reduced very small because you're looking at a 15-second time frame. Now, don't think for a second that the 15 seconds just answers all the equation and problems of larger stop losses, because if you don't know how to read price action, and if you don't know what that 15, 5, and 1's doing, just because you looked at a 15-second, some of you are thinking, oh, he just gave me the shortcut. There's the shortcut. All right, ICT's the plug. Like, hey, he just gave us the secret. This is the golden ticket. Don't look at anything else, folks. Everything else is distractions or red herring. 15 seconds is the answer. And when I started talking and trading off a 15-second chart, I got responses like that. Like, oh, bro, like you're the goat. Like you've tipped the hand. Like you made it's easy for us now. And then invariably, weeks later, they're like, I don't know. I'm getting chopped up on this 15-second chart. Right. Yeah, because you thought you were just going to jump to the head of the line and no adversity. And you can't do that. So, son, when you're doing this, I know right now he doesn't have, just so you know, he doesn't have a membership or plan through TradingView. Okay. So that way, here's what you maybe don't know, but my private mentorship students have been monitoring this for a little while. We're probably gonna go to like 9:20. By the way, I'm looking at the time. But all of this is essential because I'm going to answer a lot of questions that you're going to keep trying to send to me, and it's going to frustrate me because I am answering them in the dialogue. But my son doesn't have live data, okay? And you're probably saying, well, what business should he have trying to learn this stuff if he's not looking at live data? Because I am talking to him and I'm telling him up until recently now, I would tell him by me either entering a trade live, not market replay, not hindsight stuff, I would point his attention to a specific level. Like I was outlining it yesterday for all of you watching. And thank you all for giving a thumbs up. I appreciate that. Last time I looked at it was 17,000 thumbs up. So it's like 10%, 170,000, 175,000 people watched the video or live stream, either replay or whatever. It's still a little bit lower number. So, I'm trying to figure out what you were expecting because I literally did exactly what I said I was going to do. But he watches delayed data. And for some of you that can't afford TradingView stuff, um, they do a Black Friday sale. And last year I bought like 6 years of TradingView membership at the level I have, which is the highest. I use the highest one. And I think it was like $600 or something like that. I got like 6 years of like everything that I use right now, which is the highest membership. You don't need the highest membership, okay? But I'm not a representative for TradingView. I'm not trying to invite you to spend money there. This is just the medium that my community asked me if I would use when MT4 became exposed as a way for people to rig it, okay? And people accused me of using a white label broker, and I've already smashed that lie and conspiracy. It's destroyed. You watched me do it yesterday. Okay, I know what price is going to do. I don't need a gimmick. Okay, I don't have a fake brokerage firm that like Hanko Trade. Okay, oh yeah, they make this person look like he's made a lot of money, and I can go in and edit my trades, and that way you can get other people to go in and sign up with them. They can lose their money, and these types of brokers, keep the money because they debook you, and that's an opinion. That's not my opinion. I've heard other people say that. So just for the people over at Hanko Trade that want to send me some mail, just know that I'll respond to that accordingly as well. I'm using an analogy that's been said and bandied about by other people. I would never trade with Hanko Trade, by the way. But the point is, I'm using a medium that the community introduced to me. I didn't even know anything about trading yet. So don't think that this is an invitation for me to make money. There's no business arrangement with me. TradingView has asked me in the past to have some kind of partnership. I have declined that. I still have the messages that's been screenshot. I can load that up on my TradingView and show it to you. But for privacy's sake, I'm not going to disclose the person from TradingView, but I've been honest. I've never had an affiliate with anyone. So my opinion is always raw, it's honest, and sometimes it's going to be appearing disrespectful to them if it's something I don't agree with. If I say there's something that there's a problem with, I don't like it, like for instance, FXCM. I think they're a shit broker and they should have been shut down entirely, not just move out of the United States. But that's my opinion, right? That's my personal experience with them, and I'm glad that the US can't deal with them. And they did you a favor by leaving. Long story short, he has a task of securing on Black Friday a trading view plan or membership where he has real-time data. So he has what? He has a few months because Black Friday is in November. So he is not going to need or require live real-time data at all because I'm providing that perspective. I'm providing that. Okay. I'm coaching him along. And then because he's doing it with a delayed data, I am pointing at real-time data and a setup that I'm expecting to take a trade on, drawing to a pool of liquidity, whether it be relative equal highs or relative equal lows. And then he has the benefit of not even having any hindsight advantage because he's now, what is it, 15, 20? I don't even know what the delay is. Okay. Whatever the delay is on TradingView, like if you don't have a membership and you're looking at the futures chart, I don't know what the time limit or deferred delivery of whatever the real-time price is right now for me or anyone else that has real-time data versus what TradingView shows you. Like I don't, personally, I don't know what that is. But Caleb doesn't have any advantage. He doesn't have any resource to tap into to see, okay, I want to impress dad, but I'm going to cheat and I'm going to look at a chart that has real-time data. I know it's going to go there in the next couple minutes. So therefore, I'm going to trade this, or I'm going to say it's going to do that. See, he hasn't had any of that. So because of that, he has a unique perspective as me as his dad. I have the experience. I can see it real time and know what it's most likely going to do more times than it's not. And then I enter a trade. So he can see dad doing it right, dad calling it, dad executing on it, dad managing a real stop loss, managing the stop loss throughout, and then watching the targets get hit, or if it reverses and takes me out with a stop loss that prematurely exits the trade. He sees all that stuff, as it's going. I update it constantly as it's going on. But then he has the ability to see the trade forming with me, telling him what I'm doing with my account with real-time data. And it's a unique learning experience because number one, he has me telling him what I'm doing real time, but then he can stalk the chart. He can see it as it's forming, knowing that I have placed skin in the race with my execution. I have face to save. I have money to lose. I have profits to make. I have a real management engagement with this idea. Whereas he has just the luxury of, I don't have to be right or wrong. I want to wait and see when the chart presents the things that I'm trying to learn. And when it's given to you like that, it's like the best of the best. And for anybody that has an issue with that, you're an idiot. Okay, because he has all of the advantages and none of the disadvantages. He can't lose money. He's being primed to look at it at the right time, and it's always the same times all the time because the market is algorithmic. So it subconsciously trains him, and he's learning on the surface level what he should be feeling and how he manages expectations over time. And until we get to Black Friday, which is in November, he'll purchase at a discount rate because TradingView always does a very, very deep discount. And I don't recall how much it is because I don't worry about price tags, but I bought it at that time because I realized I was spending full price by buying it in January and I didn't know they were doing Black Friday. I don't usually worry about Black Friday sales stuff. Like if I want something, I just buy it. And I don't really care to know what it costs. I don't shop around and try to get a good deal. I don't give a shit. If I want something, if it's in front of me, I'm taking it home with me. Well, TradingView, I'm telling you, if you're buying it any other day except for Black Friday, you're wasting money. So there you go. And they're probably gonna be mad at me because I said that, but Caleb isn't going to be spending any money on TradingView, charting, or real-time data until that month, so the third Friday of November. And then he'll have the ability to see things real time too. But he has, at that time, he has several months of learning how to anticipate these things that he watched me do, like you did yesterday. But he's been watching me do that for a while, and my students have been watching me do that for years. It doesn't change, it doesn't morph. So let's go into the business. All right. So if you go over here and you look at my 15-minute chart, I know that's a really long monologue, but you have no idea how many questions I get and how those types of segments of my delivery removes a lot of headache because people get mad at me like I'm ignoring them and their questions, and it's not about you, bro. Okay, you're not the only person I'm talking to. And the 15-minute time frame, what you're doing is you're looking at time first. And let me first cancel out the confusion I probably caused some of you. So here's 7 o'clock in the morning today. All right. You want to put a vertical line on that. It doesn't need to be a very bold color or anything like that. You want to just be able to annotate 7 o'clock. Okay. The things I mentioned yesterday where I said you want to start at 7 o'clock in the morning, that's true, Caleb. You don't want to look at anything prior to 7 o'clock because you are not versed in anything with the London session. I'm not expanding your focus and time beyond the scope of 7 o'clock in the morning, New York local time. That's your punch in time. Okay, that's the earliest you can refer to in price. If we look at, now pay attention to this, okay, because this is going to answer the confusion I caused yesterday without really wanting to. At 7 o'clock in the morning, that begins your hunt for relative equal highs or relative equal lows. What I meant to say, but I wasn't very successful or articulate in the way I said it, is when I was referring to the London session, you do not, this is the part where I said this is really important, this is key takeaway information, do not look for your relative equal highs or lows prior to 7 o'clock, Caleb. That does not mean students that have learned models from me in private mentorship that they shouldn't be doing an observation on these relative equal highs. Because if you're looking at prior to anything at 7 o'clock in the morning, what you're really doing is you're referring to London sessions price data and its profile, not market profile where it has the volume, horizontally, okay, like it's something special. That's not what I'm talking about. Market profile is it making the high or low of the day in London? Is it setting up a consolidation to expansion trend day? Or is it going to be just a trending day? Is it seek and destroy? All those profiles I taught, they're on my mentorship videos on this YouTube channel for free. You don't need to pay for them. You don't need to go to somebody else's 5-minute trainers. And I promise you, they don't know how to use them either. This reference point at 7 o'clock, if you know how to trade other price action models or ideas that I taught, and you've been with me as a student for a while, and you do trade London setups as a continuation or a potential reversal for a New York session market reversal profile, where what that means is London session between 2 o'clock and 5 o'clock in the morning Eastern time. That's New York local time always. If that session time has seen the market drop like we see here, okay, if there's going to be a New York session market reversal profile, that means that they're most likely going to see price trade back above and overlap all of the movement that was started at 2 o'clock in the morning here. Well, if you're a brand new student of mine, or if you've been familiar with some of my videos but you just feel confused and you've never been able to find a footing on how to start, where to begin, this is what I'm teaching that to my son Caleb, because he's in that same boat. He has familiarity. He's had Top Step account. He's done all that stuff, but he hasn't seen consistency, and he doesn't really know what he's doing. This is what I'm going to do, and I'm only going to do this. So what I'm trying to do is I'm stripping it down to the chrome and saying, this is what you focus on. You start here. And then when he shows me by his progress that he understands what I've given at this point here today, then I will expand his circle of focus and his intentions on other factors of time. But you don't need anything. Honestly, you don't need anything extra outside of today's stuff, what I'm going to teach today. So in clarity, if you are a trader that understands day of the week and time of day and London session trading and how it can communicate a potential continuation or reversal in the New York session, you should have been fine with yesterday's commentary. But for the folks that don't understand how to trade the London session and how to integrate that with the New York session and how it works together to make the daily range, that could have caused you a great deal of confusion. And I did. I saw a lot of folks in the comment section saying, you kind of like, you made two statements that are opposed to one another. At one point, you say, look for relative equal highs and lows prior to 7 o'clock in the morning. And what I'm talking about is for anyone that wants to look at the London session and you understand daily range and you understand all the other things I've taught, and you're more of an advanced trader using my concepts, you can look for setups prior to 7 o'clock in the morning. But if you're brand new, don't even worry about that right now. Trust me, you don't need anything else prior to 7 o'clock in the morning at all. So for clarity's sake and simplicity, and to remove all the complications that you probably thought was being thrown in there, at 7 o'clock in the morning, what you're doing is that's your beginning of the day. You're now starting to look for relative equal highs and lows. And you start on what time frame first? The 15-minute time frame. Okay. So this starts the hunt for, at 7 o'clock, did we create a relative equal high yet? No, we just have one singular high. Do we have relative equal lows? Don't look at this because it's before 7 o'clock in the morning. Don't do that. Don't even refer to it. The rules are very simple. You're waiting to see relative equal highs and relative equal lows form after, post 7 a.m. New York local time. Now, these two lows may be a factor for the 5-minute chart. So we're going to go to the 5-minute chart and expand that. All right, so now we do potentially have, if this starts to rally, we don't have it yet, this could potentially become relative equal lows. Now with that, all you're doing is you're making a mental note of it. You're not annotating your chart because it's not there. You never, never, never lead your expectations with something that has not actually formed in the chart. Don't predict the setup. You have to wait for the setup. You have to wait for these signatures to form in price. You cannot anticipate them. You don't know what you're doing yet. I can do those types of things. You've watched me do that with calling inversion fair value gaps before they actually formed. And people insisted that it was after the fact, annotations. it's not. So the point is that experience will be given to you by exposure and repetition. That's the only way you glean the experience. You have to do these things, and they are monotonous. They're boring. They feel like they're fruitless in the beginning. It feels like, what am I even doing this for? And that's why I'm talking to you this way, because you're going to want to not do this. You might do it tonight, today, or tomorrow, maybe the rest of this week. But something's going to happen. Next week, you're going to want to do something differently because it's not making you money. You're not pushing a demo trade, and you're going to mess up. You're not going to learn. You're not going to progress. You're not going to understand yourself and what you're expecting to see in price action because you're not doing enough of it. Just like working out, everybody can join the gym, but you're not going to stick to the process of eating well and exercising and sticking to that regimen and that routine to see the results finally come that you're going to have to wait for. Those results are a deferred result. Everybody wants to join a gym and lose 10 pounds in the first 2 days and feel like I made the right decision. But you have to submit yourself to the process that these results that you're wanting, you're going to have to wait for them, but you're still going to have to do a lot of work every single day working towards those results that will come later on. That's the problem with millennial mindset in trading. All of you millennials out there that are trying to be substantial or significant in this community, you're rushing to try to be significant with no talent, no skill or understanding, and no prowess. And if you do what I'm teaching you today, you'll get that for real and honestly. And in that skill set, no one can take it away from you. I won't be able to talk down to you. No one else will be able to talk down to you, because you'll be able to carry yourself with a skill set that no one can strip away or diminish. And that's what everybody should aspire to have. But I'm promising you, you're not going to get it quick. 5-minute trainer videos, 5-minute mentorship guys, they're not going to get you there. Okay, this is the way you get there. It's blood, sweat, and tears. It's doing these very boring observations. So post 7 o'clock, you're scanning through, looking for relative equal highs and relative equal lows. We can't refer to that low because it's before 7 o'clock in the morning. So we go down to a 1-minute chart. I'm just going to toggle through on the chart itself. And here is the 7 o'clock delineation. And you're looking for relative equal highs. Now, these have already happened, okay? So that's something that you could have observed at the time at 7 o'clock in the morning. We weren't here, obviously, at 7 o'clock. But it ran through there. So what did this do? Okay, think about what I was talking about yesterday. There's two different characteristics in price delivery that is a very, very simple perception of what price has done. It took an area that's smooth and made it jagged. So what happened here? This was an engagement for liquidity. So what did it do? It took buy side. After it took that buy side, where did it go directionally? Lower. So if it's done this type of work, then you have to go back through this price leg from here down to there. See that? So what you're going to wait for is something after 7 o'clock in the morning to create relative equal lows. It could rally up, and then these relative equal lows could be the setup for a run lower. And if it goes below these relative equal lows, and I'm not saying it's there yet because I'm not trying to push that on you today, but these are the things you're doing as you're watching the chart. You're observing and referring. So if these become relative equal lows and it rallies higher than this high here, these become relative equal lows. And if it wants to go below that, how far can it go? Refer over there. That's not the same thing as looking at relative equal lows before 7 o'clock. You're just looking for liquidity for the sake of just simple liquidity. And you're referring to how far can it go beyond relative equal highs or relative equal lows. You got to look at market structure outside this parameter. But initially, all you're looking for is to get a draw or a short-term bias on a time frame, whether it be 15, 5, or in this case, 1-minute chart, where it affords you movement. You're watching to see how it attacks or tracks to a relative equal low or a relative equal high. We already see that they've done some work up here. There was a shark frenzy, okay? There's blood in the water up here. We don't want to trade up into that. We don't want to trade into this because they've already done a lot of things in here. So what we're doing is we want to see it try to make an attempt to run out some kind of a relative equal low. That's what you start with. It doesn't mean you're right. It doesn't mean it's going to pan out. It's just that's what you start with. That's the process. So you work from the 15-minute time frame, look for relative equal highs, relative equal lows after 7 o'clock in the morning. Even if you see them obviously right before 7 o'clock or during the London session, ignore them. All you're trying to do is learn how to encapsulate price action. If this price, say all this price action here was over the course of, I don't know, 15-minute time frames or 30-minute time frames, and this was the close at 4 o'clock in the afternoon New York time. What that would indicate is that this was the daily range. It created the Judas swing here, it dropped down, and it came off the low to close near the low of the day. That's power 3. You're going to discover that every single time you sit down and you look at the AM session, you're essentially looking for that to form. You're looking for some fake manipulation that creates all this animation, and it does the harmful work of hurting people and putting them out of a trade that would have been profitable or putting them in a direction that's not right. And now they're trapped long in this case, and then they rake them across the coals and drop it lower. So you're looking for where the retail or street money trader is going to be, or less informed trader, they're going to be looking for support and resistance. I'm not a support and resistance trader. I don't teach my students to trade support and resistance. We look for liquidity and inefficiencies. And when you go through the process of looking for all of the relative equal highs and relative equal lows on the 15-minute, the 5-minute, and 1-minute chart, once you have either panned through and either identified what's available on any one of those time frames, or if there is none that's obvious, then what you do is you go through your charts and you annotate all of the inefficiencies. And we're going to work our way back up. So right now we're on the 1-minute chart. So this would be like this. You see this? There is no volume imbalance in here. So you're going to start right, the candle's low, drop it down to the very next candle after the big long down close candle. What kind of candlestick fair value gap is this? It has a down close. What did I teach you yesterday? A down close fair value gap is a SIBI. Stands for sell side imbalance, buy side inefficiency. That means it offered delivery on the downside. It's inefficient in any movement back up inside that same range that creates this one single pass through until you get into this area here. So that's the furthest we went back up into this range right there. So it's inefficient by characteristic and definition. Anything above this high up to this candlestick's low right there, that candlestick's low. All of that is inefficient and is inviting the opportunity for price to want to trade up into it. Doesn't mean it's going to happen right now. Doesn't mean it's going to happen this session, but that's the characteristic. Then you have this one in here. We've already worked this one there. So there's a small little section between that candle's low and that candle's high. Maybe you didn't see it. Maybe you did. If you didn't, don't beat yourself up about it. I've been doing it for a long time, but your eye will jump to these little gaps and these small little inefficiencies where they may seem insignificant to you right now. Like, really, why would you even highlight that? That's like nothing. Meaning that from this candle's high and that candle's low, essentially this is what's remaining in that little small section. And I'm telling you, I've entered trades and recorded myself doing it with real money and shared it with you where I've used levels just like that and placed limit orders just below it to get filled, and it never has any significant drawdown and just runs and takes off, goes to my limit order for a target. If you're a student of mine, you're in private mentorship, you've seen some of those things lots of times actually. And then over here, this inefficiency, let me fix this because I always want to refer to the original fair value gap, but noting what level of inefficiency is still available. That means the small little section between this candle's high and that candle's low right there. So I always keep the original fair value gaps, the levels, because they're key. They can be used again. They're influential. It's not so much that I'm only looking for the remaining unfilled portion. I am aware of seeing that because I can see the difference between the high of the fair value gap and this high of that candle. So I'm not trying to make any special distinguishing note of it. But in my mind, subconsciously, I know that if I'm going to go back to that, it may go back here just to tap the high of it, and that'll be it. Or if it goes above it and comes back down, then I could use this candle's wick and the halfway point of it. That's how far I can retrace back down into it, and it becomes an inversion fair value gap. When I have a candlestick like this, okay, when you're annotating your inefficiencies, we have this one here. There's no volume imbalance up in this segment to here. Is that accurate? Look closely. What's wrong? The low of it needs to incorporate that volume imbalance right there. The volume imbalance is the separation between one candlestick's body and the very next subsequent candlestick. If the bodies don't overlap or at least touch, there's a volume imbalance there. I'm quite certain you're not going to see any information about that unless someone else wrote a book about my concepts. And this is new stuff. Okay, I introduced it to the community, and it is very, very influential in terms of reading price action, in terms of precision elements. You have to incorporate that. That is your fair value gap. Why? Because the wicks are not the true narrative. That's where the damage can be done. It's like your child that colors with a crayon in a coloring book. They color sometimes outside the lines. You know that they messed that up, but you're not going to sit down and say, look here, Billy. I don't know how many times I got to give you this lesson, but you will not be eating dinner tonight because you colored outside that picture again. Sure, sure, sure. You'll do a better job next time. But right now, it's no dinner. You're not going to treat your son like that. If you do, you need to get stomped. But if you see your child do that and it colors outside the line, what do? Oh, he colored a picture for dad or mom, and you put it on your refrigerator or you take it to work and you hang it in your cubicle because you're proud of him, right? Because you know that that's just an aberration. It's just something that just happened and it's not a big deal. Well, that's how I look at Wix. Yes, the algorithm repriced up into there a little bit. That's fine. Where's the body? Right there. So volume imbalances here. This is the stuff you're supposed to be writing down, folks. If you're just listening and eating potato chips, you're completely oblivious to what's being introduced to you. The volume imbalance tells you to ignore any of the wick. This wick will not be all that influential. Whereas if you were without a volume imbalance in here, let me zoom in because I really want you to see what I'm talking about because I'm not sure if you can see it well. Some of you guys are trying to learn this on your smartphone. And I've got students in prison that are studying and they're like, man, I wish you could zoom in. This brother just read my mind. How do you like that? So that's the volume imbalance right there. Okay. So if you have a fair value gap or an imbalance and it has a volume imbalance in it, any wick inside the fair value gap just completely nullify any intention on that. Now, find that in your textbooks. Find that in your rip-off ICT mentorship 5-minute trainer guys. They're not going to tell you that insight because they didn't make it. So the volume imbalance right there, that tells you if you have that and any wick in there, just completely disregard it. Only if it's a wick that's below the consequent encroachment, which is the halfway point here. So any wick that reaches up to that level or less, ignore any of those wicks. You have to take it to the body of the candle. Okay, so that gives you the true, real fair value gap, or in this case, a SIBI, sell side imbalance, buy side inefficiency. All right, so that's the business there, and extend it out in time. And the market goes right up to that high and then folds and creates what right here? What is this? That's that fair value gap between this low and this candle's high. And you see it trade right up into consequent encroachment plus a little bit more. Why? Why? Because the algorithm is affording anyone that uses this information, that uses this level as an entry point, they have to offer them the spread, right? Or they won't get their fill. And that's why you get this little bump right above right there. But you're going to be told that that's buying pressure. The buying pressure just happens to stop at levels of precision that fit inside the narrative that I've proven to you over and over and over again with live price action before it happens. Folks, as we go through this, that onion, okay, that sits in the skull of yours that you think is a brain, I'm going to be peeling back those layers and getting rid of all that crusty shit, okay? We're going to get down to the sweet kernel in the middle, and you're going to find out that there really is an algorithm. And it really is absolutely 100% manipulated and controlled and scripted until they manually intervene. And then it seems like the markets are random. The markets are controlled by buying and selling pressure. Wrong. Absolutely not. So you have all of these levels here, and I'm going to leave it up to you to have a color scheme that you like. Okay? Meaning that you're going to come up with the scheme exact, because people are always like, can you show us the colors that you use for your candlesticks? I get nervous when I see stuff like that because I know invariably what that means is there's somebody that wants to start putting their charts out like mine. And they want to put my videos and clips and whatever on their Instagram or their other social media, whatever, and pretend that they did these trades when I'm recording myself doing them. And then they can't show something after the fact or explain it in hindsight because now they know that the move happened. They can't have their charts look like mine because they won't match the color. So it creates a problem for them and they're fraud. So I don't sit down and try to show you the actual hue or color of here. In fact, this these charts may actually become a different color, and the background may change also because it's starting to bother my eyes. And even with the blue filters that I have on, it's still it's a little irritating. But you want to go through the charts and you want to highlight these things. And since we have done this work up here, where we had relative equal highs here and here, what did I teach you yesterday? How do you know it's a high probability relative equal high? When the right side that is identified as a potential turning point for a quote unquote potential relative equal high, the right one is going to be slightly lower than the one on the left. We have that here. We don't even need to see this ahead of time. We just need to see, okay, it ran that, and you might identify it after it does that run there, and then you start seeing it break down. See that? At the turning points or potential turning points like this, okay, this is where, and I'm going to refer to this in my book with this lecture here. I've taught and introduced inversion fair value gaps on Twitter Spaces last year, okay? All of my PD arrays have an inversion aspect to them. Every single one of them. Every single one of them can reverse their role. Every single one of them. But it's not easy for you, and it's not easy for people that want to try to teach my stuff for money when you're actually getting it right from the source here for free. It's not easy for them to be able to teach that because I've never went into great detail like I will in the books. So that way it kind of like bridges the gap. And then you'll see everybody start teaching it then. But this is a note that's real important for you, okay? Inversion fair value gaps, the highest form of precision, the ones that are really, really trustworthy, the ones that have the highest degree of working in your favor, depends on your understanding of what I taught you yesterday and what I'm building on here. Whereas we have an area that's smooth after 7 o'clock, so the 7 o'clock in the morning starts the AM session. So now you start hunting on the 15-minute time frame, the 5-minute time frame, and the 1-minute time frame. You're hunting relative equal highs and lows to form after 7 o'clock. Well, we have that here. You may not have had the experience to anticipate this run up. That's fine. You don't need it. You don't need it. Remember when I first taught breakers? I taught that on baby pips back in 2011. Yeah, I think it was 2011. If it wasn't, it was 2012. The idea of waiting for a stop run and then wait for the market to come back down in to the range prior to all that run up, and then wait for the bearish breaker. In this case, the bearish breaker is this candle and this candle. The most sensitivity is going to come inside of the most lowest down close candle prior to the run up, because you have a high, a low, and then you have the stop hunt, and then the reversal. Well, that's trading with a breaker. Inversion fair value gaps, if you have a gap inside of the range that creates the bearish breaker, as we have here. Now remember what I taught you. A down close candle that is a fair value gap is a SIBI. A up close candle right here, this is the opposite, which is a BISI. B-I-S-I. Buy side imbalance, sell side inefficiency. Now, this is going to be a huge step in understanding narrative and understanding directional bias and also reversal patterns. This fair value gap here, if you don't understand what you're looking for and you don't have the element of time, Dave, and you trade back down into this fair value gap, you might be lulled into thinking, well, wow, this is an opportunity for me to take one of those ICT fair value gap buys and go long. And then it's to your detriment that it reverses and collapses on you. Understanding that it's 7 o'clock, post 7 o'clock, we have relative equal highs. It rallies after, remember the new week opening gap I talked about yesterday? You're going to discover, Caleb, that your model is going to be gravitating towards those new week opening gaps. That's your model. You're going to be trading in that direction. But before we get to that, you have to be able to look at small, small, small fluctuations around segments of time that will have a repeating phenomenon, that they all look very similar to one another. It's a fractal, okay? But the fractal element is only repeating and verifiable on the time frames I'm teaching you to focus on right now. We're not going anything higher than the 15-minute time frame. But this buy side imbalance, sell side inefficiency, that fair value gap, is going to have a role reversal where everyone else that thinks they understand it because they've been introduced to it lightly, that is an inversion fair value gap. So the market creates this fair value gap after this run here. You don't want to use that as a buy. We're so elongated and stretched out from London, and it's past 7 o'clock in the morning. So now we're in an AM session. AM session characteristic is always, first and foremost, characteristic is retrade back into the London range. The London range is whatever the highest high and the lowest low was between 2 o'clock in the morning and 5 o'clock in the morning, Eastern Standard Time. Now, I'm going to slow things down here because I already know some of your heads are spinning. You're like, dude, you said this is going to be easy. You're not complicated. What I just said is not complicated. You have to look at these specific times of the day. So if we're anticipating a rally up because of these relative equal highs, and it's after 7 o'clock in the morning, and it creates this type of reversal scenario where it breaks down, your eye should go right to, are we looking for relative equal highs or relative equal lows, or are we looking for inefficiencies? You have to go with what the chart's giving you. You can only trade with the premise of relative equal lows or relative equal highs if it's in price action. If it's not there, you can't refer to it. So if there's nothing else in price, because we want below these relative equal lows there, what's left now? At this price point right here, if there were not anything else on the chart yet over here, this is the only chart candlestick at the time you're watching it. Where does your eye go? Well, you'll naturally go to this, but my eye jumps to the stop hunt here and the breaker. And from the breaker to the high where the stops were taken, is there a fair value gap? If there is, I'm going to navigate away from the breaker, and I want to have that premium level right there. I want that. That's the one I want. Everybody else might be trading down here, and they might get a fill right there, and they won't be comfortable trading into this high here or right there. See where it's stopping? It's not random. The market breaks down. That Q, working off of that inversion fair value gap, that drop, and it creates this gap right there, that right there is the sweet spot when you're bearish and you have everything behind you that's in play. It's your optimal trade entry. It's your model 2022. It's right there. And then this becomes a selling point. And then what do you have at this point? You have this low and this low. And what time of day is that? 8 o'clock. So the price is rallying up against the underlying expected move or directional bias, because this move here has caused a potential reversal. So now you have relative equal lows here. But how far can it go? You have to refer to the range prior to that reversal pattern that formed after relative equal highs have been taken. So let me slow you down because you're getting a little panicked, I'm sure. This is too much information, my head's spinning, ICT. All you're doing is you're looking for areas where they can stop people out and go the other direction. That's essentially all you're doing. And you're looking for little periods of price action where obvious highs can be targeted, obvious lows can be targeted for liquidity purposes. And in between them, or if there's nothing new to work off of, then you focus on all of the fair value gaps, the inefficiencies. That means things that we've been coloring here with the rectangles. Okay? Your eye will jump to them with experience. You'll see them more the more you do this. And because of that experience factor, you'll learn to filter out some of them because they've already been used several times. It doesn't mean that they won't be used again. It just means that the ones that are unfilled or left in a state of imbalance, like this portion of this gray box here, from this candlestick's high to that candlestick's low, there's a little bit of inefficiency. And graphically, it looks like this. That's the remaining portion that's inefficient, that little segment up there. It doesn't mean it can or needs to fill it right now. It just that's the part that my eye goes to. But you still want to have the low, the midpoint, which is consequent encroachment, and the high. You want to have those levels all the time because they will refer to them. If the price is trading anywhere around this range here the rest of the day, watch and see how it uses it. It will use it again. So if you want to talk about support and resistance, these inefficiencies are the real support and resistance in price action. You'll see them, kiss them, turn on a dime, go right to the level, stop, turn around, the bodies of them stop. Like it's so precise. It goes without question. It's laughable for anyone to say there isn't an algorithm. These price engines, what are they referring to? Think about it. What are they referring to? They have, if it's an algorithm, it has to refer to something it's happened in the past. So what I've done is I've created a language where you're either going to be reaching for old highs for the express purposes of taking out or engaging that liquidity that would be resting above it in the form of buy stops, or going below a low or equal lows for the express purposes of going down to engage the sell side liquidity or sell stops. Outside of that, what are we left with? Anything that's inefficient in terms of price action. So if we have a inversion fair value gap here after these relative equal highs have been traded through and it starts to break down, no panic. Don't worry about panicking. There's no reason to do that. Go into this price run here. That's your breaker where it runs up and tags all the stops, gets people stopped out. If they were short, they're not allowed to be profitable. Or trick them into a long trade, and then when they start raking them across the coals going lower, they're unprofitable. If that's the case, your eye goes into this price run. Is there a fair value gap there? If there is, extend it forward and then wait for it to trade up there. Don't sell yourself short and only look for the return to the breaker or the low point because it's going to trade right back up into that. And if you go back and look at your examples, maybe you've taken trades, whether it be live, demo, whatever, or maybe you've done some annotations in chart work and journaling and you were focusing on studying on the breaker. Go back and see if this signature doesn't appear in some of them, and maybe some of the things that you would have taken as a trade there, or maybe you've taken and got stopped out. This was the factor that you didn't see it happening. And notice that this is the only buy side imbalance, sell side inefficiency. And once you have a valid return here and it sells off, what you should be focusing on is all of the SIBIs. All of the SIBIs until the narrative is likely to change bullish. Your focus goes to only looking for sell side imbalances. That means a down close candle that has a segment with the previous candle's low and the subsequent candle after it has a high that doesn't connect. And the only bridge between those 2 points is the down close candle in between. That's your fair value gap. And it's specifically a sell side imbalance, buy side inefficiency. And by having that, what that does, it removes the ambiguity. And it gives you a very specific process of saying, okay, I'm only focusing on these specific fair value gaps. I get that question a lot, even with private mentorship students. How did I pick that one? Why did I pick that one? Why didn't I pick this one over here? Well, that comes with experience. And it may seem like a cop-out to some of you that do straight ass hats and you don't really want to take the honest truth. There's some things that you're going to have to get with experience. And I don't make any bones about it. I don't sugarcoat it. And you're going to pick it up because you've been doing it long enough. But to get that experience that's required to do a lot of things that you're asking for answers, you got to do what I'm showing you here. And you can do it after the fact. You can go back and look at it. And yes, you have the added benefit of hindsight. Don't discourage yourself in that, because anything you learn, every surgeon that ever did a surgery on you, they studied in a book. They watched other surgeons do it first. Then they worked on a cadaver. It's a dead body, okay? Where if they cut some artery or something, they make a mistake, the person's not going to sue them for malpractice or die on the table. They're already dead. So they're demo trading with a corpse, okay, or they're demo surgery with a corpse. But when you start looking for it, there's specific fair value gaps, Caleb, that I want you to focus on. Okay, the very first fair value gap prior to a stop run, always, always, always have that one noted, and that's why it's colored red here, or pink if you want to call it that, because this is a change in a direction, and what this is doing is acting just like an order block. It's just change in the state of delivery. Oh, so I'm incorporating narrative where the market goes up after 7 o'clock, stop hunt, change, breaks lower, comes right back up into inefficiency, but to a very specific fair value gap. It's the first one prior to a stop hunt. Okay? There's going to be lots of times where this doesn't form, and that's okay. If it doesn't form, what do? Throw everything out the window and start trading supply and demand and Elliott wave, because nothing's going to work for you. I had to toss that in there. I had to toss that in here because some of you are falling asleep. You're like, oh, dude, he's droning on. I don't know what's going on. This fair value gap, okay, if it's not there, then you use the breaker. It's very simple. It's the last down close candle, okay? But your stop needs to be above the highest high of the consecutive down close candles, because this is all the bearish breaker, both of these candles here. So your stop has to be above that, okay? How much? Two ticks maybe, one tick. Many times I've used this the high, because if it's really good, it really won't like to go back up into the full range of that. So using the very high of that, in my case, it would be fine. Not if you have this gap here inside the leg that has the stop hunt, because if you have that, then you could potentially see a whole return back up into this, and maybe a little mohawk, a little tiny little spike above outside with the wick of the candle, but the body be inside or below that gap. So that's all part of stop management. So I tossed that in there with no extra charge. But that changes the state of delivery, meaning that we went up to stop out, and then this is where everything algorithmically changes. Now we're going to start going lower. It's going to seek sell side liquidity. It's going to reach for sell side. It's going to expand lower. So you want to key off of and look for turning points, or what will be future entry points for you, Caleb, for trades that key off of these sell side imbalances, buy side inefficiencies. Every single SIBI, every single short-term high. So why do you want a short-term high noted? Even if it's a singular one. Because there's stops above that, okay? We already have a relative equal high here that formed, and it caused a potential reversal that moves lower, that seeks liquidity. We had relative equal lows here. It traded down through that. And then we had all this business in here. We swept below that here. Actually, it's kind of sloppy, isn't it? And it's 9:40. Well, whatever. You're not paying for it. I'm giving you something extra. I wanted to be done sooner. My wife's probably thinking, hey, every time he says he's going to be this much time, it's invariably going to happen. If I say it's going to be a little one, it's going to be a long one. But I really can't do a 2-hour one today. So we'll probably end up doing a 2-hour one. This guy's bipolar, and he says one thing, and the next minute he changes his mind. That's what it's like being in my mind. It's a beautiful place. So every sell side imbalance, don't see anyone of in here. Yeah. Notice how this one here, what is this one? What's this fair value gap? By classification and name, what would you call that one? So buy side imbalance, sell side inefficiency. Okay. I'm not looking at that one. I won't highlight that one. I won't extend it forward, because it's against the underlying direction and the state of delivery, which is it wants to go lower. So if it wants to go lower, I'm not interested in this unless it shows me that it wants to reverse and it's done something very violent down here. Like it could do it here. I'm not saying it will, but if it did something violent and started to reverse, then I would draw my attention to this one, because then I could act on that as an inversion fair value gap, because it would reverse its role. But right now, when the narrative is in motion, every sell side imbalance, buy side inefficiency, I'm referring to. I'm not always drawing them out on the chart, because as you'll see, it can be rather busy on your charts, and I like to keep things naked but not afraid. And you can see it trading up into the consequent encouragement of that one. So when you're trading, or not, sorry, when you're observing price action, you're spending your time not pushing a button trying to trade. You're not trying to convince people in live chats in their chat window. You're not trying to tell influencers what you think is going to happen because you're going to wait for a high five, like, yeah, bro, or yeah, sister. You know, none of that stuff. You're in your own little bubble every single day, and you're looking for these things to unfold. Now, if you recall, I mentioned yesterday. Let's do that right, Michael. Come on. At 8 o'clock is the same thing. There's another point of confusion I want to clarify. I talked about the first 30 minutes after 7 o'clock and after 8 o'clock and after 9 o'clock. That is your pre-session range, okay? It is 30 minutes of you expecting something opposite. So in other words, if you see relative equal highs, what would you expect after 8 o'clock? You would expect a low or a price run lower. What is that by definition? Opposing directional run that's against where you think it's directionally going to go. That's a Judas swing. That's manipulation. It's something that goes against the grain of what you're expecting, not what everybody else on the internet's doing, but what you're expecting. Okay. If you look around yesterday, everybody's titles on YouTube had stock market crash, and I was in here telling you it's going to go up. Was that random? No, because everybody had the same idea. And I sat down with you, explained to you this is what it's going to do, and we wait for it to present itself, and then we put in motion a plan of where the next foothold or the next grab point, like rock climbing. Okay, a rock climber looks at the surface of the cliff that it's trying to climb, and he looks or she looks and tries to map out a pathway. Okay, I am not going to just reach up for this grab point here with my hand and pull myself up a little bit and then guess where the next handhold is going to be. They try to map out because they don't want to get to a point climbing up using all that energy and then find out they're really not in a position to grab onto something that's more efficient for the climb to go back up. Well, in this case, we have a descent. Even though they were not trying to trade relative equal highs and lows prior to 7 o'clock in the morning, if this does this and it starts to move lower, you have to incorporate the range. What range is that? The low that was formed prior to it crossing the threshold of 7 o'clock in the morning. So we have all of this run here. So every single one of these inefficiencies over here, 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 even though it's been used already, you extend them in time. And they will be places for you to anticipate price going up to and pushing into it and then resisting and going lower as it works and gravitates to that low right there, as I was hinting at earlier. But the range, okay, the pre-session or pre-market range after the top of the hour, whether it be 7 o'clock, 8 o'clock, or 9 o'clock. These are your 3 windows of opportunity. So right away, we can study and see, okay, there was really nothing in here except for these 2. Right here, these little small little ones. So what did it do? It rallied up. Where'd it go to? Some random level. Nobody could have known that it was going to go to that level. But now you do. You have a stop hunt. The market broke down. So this is a shift in market structure. Okay. And this is a optimal trade entry. Even if you didn't have all the stuff I'm teaching you here and amplifying it, you already know this. This was the flagship pattern of my channel since 2012. The optimal trade entry. A shift in market structure. Measure your high to your low. 60 to 72% retracement. 62 to 72% retracement level. And 70.5 level. See, this is one of those moments where I would hit Control and tap M, and I would have to go back and listen to the audio and edit and fix that part. But it's live, so I have to keep going. My OCD is tapping me on the shoulder. But this is still a pattern that you would have traded anyway with using the rudimentary level lessons that I taught over a decade ago for free on this YouTube channel. But now you're learning the signatures that present a greater degree of precision and managing your expectations in the narrative. How are you going to incorporate all these things and trust holding on to a trade? So now we're going to go into we have a hang on, I got distracted here. I have headphones on, so when I was listening to a phone that's on Do Not Disturb, I was still getting a flash on the screen. And I looked at it and made a mistake of looking at it, and broke my concentration. But each hour at 7 o'clock, in this case 8 o'clock, and at 9 o'clock, what you're doing is you're starting the whole process all over again. You're waiting for relative equal highs to form or identifying relative equal lows. At 8 o'clock, you can look prior to 8 o'clock. You just can't look prior to 7 o'clock for relative equal highs or lows because you're trying to work inside the range of the morning session. Okay, the morning session is essentially 7 o'clock to 11 o'clock in the morning. Technically until noon, but 11 o'clock for me. I like to be done by then. Frankly, I like to be done by 10:15, 10:30. You know, if I can get something on and be paid out, I'm done. I don't need to do anything else. You may not like that. You might want to be for the whole day. Not me. I don't want to be in front of the charts. I don't like to be chained in front of the charts. But once you have a turn in the direction like this, and the market's likely to draw lower, you'll see that by focusing on only one side of the marketplace with the inefficiencies, as we have here, it's moving lower. So every SIBI is extended to the right. Okay, if you remember on Twitter, I would tell you note a specific fair value gap, and I'd say extend it to the right. That's this. That's me doing this here. Okay, and whenever you see the market trade, through them a little bit, you'll see a troll or someone that has no idea what the hell's going on. They'll say, "Oh yeah, he thought it was going to sell." That's not what we're doing here. You're going to wait for it to cover over top of it and then break back down through it. And then it will act as what you expect it to do. Many of you, when you see me talk about inefficiencies, fair value gaps, SIBIs, BISIs, all that business, you anticipate that, oh, it's a matter of just going up. Once it gets into here, all you got to do is sell short right there. That's not it, folks. you have to anticipate a measure of manipulation. What was the price doing here? I told you it was getting kind of sloppy. We had this inefficiency, yeah, but what else is there? What else is there? You have this energetic drop that created that SIBI, and there's going to be what trailed there. For anyone that's short, they're going to put their stop loss right there. Well, that efficiently been removed with this bump here. Back into an old SIBI, and then you have a market break down. Look at the work around the halfway point, which is consequent encroachment. The market drops, opens again here, breaks lower. We have an inefficiency. The bodies are telling you, yes, this is going to go lower. Why? Because it stops right there. See that? The wicks are allowed to do what? A little bit of damage. Is it going to random locations? No, it just bumps the bottom of that SIBI over there. Right there. And then works lower. Now, at 9 o'clock, the same thing. You can look at any relative equal high or low prior to 8 o'clock up to 7 o'clock. If you're going to be trading with longer term price runs, for the folks that are asking me, how do you hold on for longer trades? In that case, you're going to have to look at the previous day's range and what is the previous day's low, or if it's going higher, what's the previous day's high? And that's your next logical level to reach for. But I don't want to give Caleb anything beyond the scope of what I've already covered because it's giving him way too many things to worry about. And if you're brand new, you're probably feeling that too. But in short, what you're doing is at 7 o'clock, that starts the hunt for relative equal highs or lows. If you see a disruption like we were talking about yesterday where it's jagged, you see how it's nice and jagged? That's that's indicating it's probably going to go the opposite direction, especially if you have all these other supporting factors where that would have been a breaker. This is obviously a high probability inversion fair value gap, and it hits it here, respects consequent encroachment, breaks down, and then we have another return in here. Here's the optimal trend entry as well. And everything is your mindset is, okay, I'm looking for lower, I'm looking for lower, I'm looking for lower, and it breaks lower. And then you highlight every single time it creates an inefficiency where it's a big candle that doesn't have any overlapping with the candle prior to it forming or the candle after it. So it creates that inefficiency, that imbalance. And then when you have these long protracted consolidations like that, it's really better for you to sit still. Let them do whatever they're going to do. Why? What do we have there? What did I say yesterday? We have relative equal highs and we have relative equal lows. You're going to be playing the breakout game. And I'm not a breakout artist. I'm not trying to guess. I want to see what the market's going to do. So by this run up, it can trade into any one of these fair value gaps in here. It does. And does it fall out of bed? Yep. So what I would require, and you've heard me say, well, not technically you heard me, you'll see in old tweets where I'll say, we want to see this fair value gap as an inversion fair value gap. Well, that means it ran above it. It's got to go below it and then do this right there, that function of redelivering to it. Then a deeper protraction lower to upset any liquidity that would be resting below here, as much as and to the degree of reaching down into that low over there, because that's the low in London. You see that? So when you have your charts, Caleb, what I'm only interested in seeing anything before 7 o'clock if the range of the morning session trades to the London session low or the London session high. Other than that, I don't want to see anything on your charts beyond this. Okay, that's it. So all your charts are going to have about 6 o'clock or so, just to get a little taste of what London was doing. And then everything else in your charts needs to be very, very simple, but I want 9 o'clock delineated, 8 o'clock delineated, and 7 o'clock delineated. And any formation of relative equal highs or lows, I want you to annotate them. Okay, and the way I want you to annotate them is, don't use this, don't do this. Okay, I want you to draw hold down shift as you drag it over, it'll keep it straight. And I want you to annotate it like that. And choose whatever color you want. It doesn't matter. Don't, just because Dad's using this color, I'm just sticking to this color right now because it's saving me some time. May not feel like it because I'm taking more time than some of you guys are wanting me to spend doing it. All right, and that's the relative equal lows and the relative equal highs. I said yesterday, when you have both of them, you wait. You wait for them to take one side out. What does it do? It runs higher. So what's it going to attack now? That one. And it runs down below it. Okay. So as it is right now, if there was any trade taken or no trade taken at all, you would do nothing because it's already done a whole lot of movement and it's back in an area where I wouldn't want to see it as a trade back in this civvy again, because we've already done once, twice overlapped it, respected it, and now we're back inside of it again. That is low probability, and it could fall out of bed and crash 1,000 points a day. It still wouldn't be a trade I took because it's against the rules of me wanting to use it. It's been overlapped and worked multiple times, and it's done enough. So your day would be complete here, and you would capture everything just like this, and then you would annotate it. Like this would be an area where you could highlight or type out any observations or what you felt about this movement here. In this little area here, you would annotate in text. So you would just take the text and say something like this, like okay? And just simple little statements like this. And what you're doing is you're highlighting your focus here and here and here. And up here in this segment, you can do something like, I like how it reacted off that inversion fair value gap. So what you're doing is you're cherry picking points of reference for your journal. And when you see the chart again the next day, like tomorrow, when you sit down, you look at price action, you refer to what it did yesterday. And these levels will be subconsciously retained as significant, and it'll reinforce it subconsciously as a memory worth holding on to. And then when the weekend comes and you go back to your journal and your charts and you have these little annotations, what that will do is you'll read this comment that says, I like the obvious return of price, and don't have any typos like this. That. Still don't know. Right? I like the obvious return of price that the cities. There we go. Getting old, folks. Getting old is one of those Biden moments. What did you say, you Republican son of a bitch? Here's one. I'm probably going to vote this year. I'm probably going to vote for the first time, and you should vote too. But I'm not going to say who I'm voting for, because then you'd probably be really hating me. But I'll tell you, it ain't Harris. So, oh man, I'm such a troublemaker. So you annotate your charts. That way you have something that when you refer to on the weekend, it is a positive reference. You do nothing negative. You say nothing negative. You criticize nothing negatively. And you draw out the things that are useful information. Okay. And when you do that and you look at it on the weekend as a reflection, you're never looking at things through the lens of regret. You notice that? And what does that do? It manages your fear and greed. It manages regret. If you missed a move, you've logged what you're focusing on. So when you look at an old chart, you're not looking at, man, I could have went short here, or I could have went short here and held for all this move down here. That's what everybody does wrong. And I tortured myself as a 20-year-old doing that. I literally whooped my ass every day in a journal, telling myself everything I did wrong, and then wondered why it took 6 years for me to get it figured out that I was doing this to myself. Like I was doing all those things, holding myself back. But I thought, well, I'm going to be hard on myself because that's what I need to do. And that was actually detrimental to my development and my understanding about how I see things in price and how I'm going to interact and how I'm going to treat myself after the fact. Whether I took a trade or didn't take a trade, whether I had a win, I had a loss, I had a win, then lost money, like all those things, you have no idea what you're going to do when you go through those experiences. And until you develop skill sets to manage your emotions and your expectations, and you do that with your journal, with role-based ideas, okay? Until you appreciate the level of responsibility that this puts on you, you won't understand it. It's easy to say, well, I'm going to trade. I'm just going to go out and start pushing buttons. Well, okay. You know, people go to casinos all the time and they go home pissed off. They took too much money and they didn't leave, or they should have stayed home because they wasted their money. And you can waste your money looking at these candlesticks and telling yourself a story that ain't there. So you have to have an expectation on price at a time of day. In this case, you have 3 specific times of the day. And the first 30 minutes after 7 o'clock, after 8 o'clock, and after 9 o'clock, if there is relative equal highs or relative equal lows below the marketplace, then you want to see a move the first 30 minutes go in the opposite direction up. If there's relative equal highs that form after 7 o'clock, after 8 o'clock, and after 9 o'clock, that first 30 minutes, you want to see the market drop. You want to see a measure of manipulation. It doesn't have to only be in that first 30 minutes. But in my mind, I'm thinking, I want to see that. And if I got that, and it was given to me in delivery price, then my interest in this move is even more peaked. I'm really interested in it. If it doesn't do it, I'll wait for more information because it might have a deeper retracement than I would have expected initially. And then I'll wait for a breakdown. And then having all these inefficiencies extended over, the market will refer back to them. And then all I have to do is wait for a bust to get there and then ride that thing down to Southern Town. And that's it, and be content with it. Okay. So another um, suggestion, and this is something you'll learn more about, Caleb, but for now, I want you to start measuring all the price swings that form. In other words, if it's moved lower, this is something you do after the fact. Okay, don't try to do this while it's happening, but after the fact. Okay, and it'll teach you range finding, how far prices can run. You're going to take the fib and your high here. You're going to take that and anchor it to the lowest low at 7 o'clock. And this is what my Fibonacci settings are. So that way, if you've never seen them, you can see them now. And then you have 2.5. All right, so 2, which is 1 standard deviation would be about right here, and then 2 standard deviations. And then you got 2.5, which is usually like the extreme for like the wick purposes, where it can just get outside the range of what you would reasonably expect. And that's kind of like a ballpark figure. Same thing happening on the 8 o'clock hour. You're going to take the fib from the high to the lowest low at 8 o'clock. All right, so we have almost all the lows in here. And then we have the Fibonacci at 9 o'clock. So the highest high at 9 o'clock that it formed thus far, and the lowest low up to 9 o'clock. And I have to go to standard deviation 1, it looks like. Okay. So we have this area in here, this area in here. Look how close in proximity that is. And then you have this one here starting at 7 o'clock. So these are all parameters without using like a thing like average daily range. We don't need to use anything like that. These are all ballpark estimates where it gives you a feel for how far it can reach mathematically. By itself, that's absolutely useless information. Useless. But when you incorporate it with real range, like we have over here, so we have below this low, that's definitely something that's possible. And if it really wants to be animated and go below that low, it can go as far as this level down here. And it got real close to it, but fell short of it. And that's fine. Which is one of the arguments when we start doing entries, when I start teaching you how to actually get into the trades and what you're holding for, the targets, what you're holding for and what it's likely to give you in terms of a profit or target. How to say, okay, this is how far it can go, but where's the highest degree of probability where even if it doesn't go to that specific XYZ target, and that's the perfect case exit point, where am I going to come to the conclusion that this is an appropriate level for me to escape the trade and be content with that, even if it moves beyond it, and see if it still goes 200 handles past where I get out. I don't care because this was such a lion's portion of the move. I'm content with that. These are types of strategies I use. Okay, I look for the expansion below the underlying market structure, and I reference it with those specific elements of time. And I don't demand that they give the highest high and the lowest low. I'm looking for a convergence of these levels in agreement with an actual old low or an old high. It doesn't need to be relative equal highs or relative equal lows. It's reaching for another a pool of liquidity. But for this model that you're learning, you're looking for relative equal highs to form after 7 o'clock or relative equal lows. And you're going to look for them to target that very draw on liquidity. And then as it goes to the next hour, if you don't have one or it worked off of one already, as it did here, at 8 o'clock, you wait for it again. And you measure that directional bias where it's likely to go. And if it is likely to go lower, your focus, your eye, this is the thing you're supposed to walk away with in terms of the learning today. Your eye jumps to all the sell side and balance buy side inefficiencies. That means the down close big range candles that are all by themselves that I'm highlighting on. Your eye jumps to those. Okay. So when you're going back and you look at last week's charts and you do this every single day of the week, Monday, Tuesday, Wednesday, Thursday, and Friday, and we sit down on the weekend and we look at this week and you'll have last week. So you're going to show me 10 charts or 10 days of data. But all of this needs to be shown at the very lowest 1 minute chart. But referring to things on a 15-minute chart if it's salient, if it has some relevance to what you're looking for based on the rules I'm giving you here. But all you're doing is limiting your focus and highlighting, okay, it's likely to go lower and reach for relative equal lows, or it's reaching higher for relative equal highs. Once you determine that, you stick with it, even if it turns against you. This is the part that some of you are going to be uncomfortable hearing because you think it's going to work out perfectly for you and it's just going to keep moving and you'll want to go do demo trades or past funded account challenges or trade with real money because you think you've learned it already. That's a mistake. That's foolishness. Don't do that. What you're doing is you're sticking with an idea and a process. And my best model isn't 100%. My best model is not 100%. So I have to build in what? I have to afford myself the flexibility that I'm going to do it wrong. I'm going to be overzealous because if I've allowed social media, other people to be against my idea, the more folks that are like that, I get really excited about that. That's when I do get excited because I know I'm a minority in a move in the marketplace that I know has a huge degree of probability. And then I many times I'll try to out trade my methodology and anticipate the setup. So this is why I stress to you, don't try to anticipate a setup. Wait for it to be there. Because if it's really there, you'll see it. And contrast that with, well, I think it's going to go up. I just want to hurry up and get in there because I'm afraid it might run off without me. And I don't want to wait for the setup. And then you get in, and then it starts squeezing against you. Maybe even trading back to a level you thought was going to be the entry for you. But now because you entered at a higher level, it's drawing money out of your account. And you're worried about that, not, well, it was originally going to go to that level and get me in. But then you get out. Or you put a stop loss in there too quick because you don't want to lose too much money. Even though that subconsciously you should have never took that trade. Okay, all those things are managed and prevented by doing what I'm telling you to do here. Don't worry about trading right now. Don't worry about entering anything. You need to be focusing on what is important in the marketplace right now. So if the market's going to gravitate lower, your eye jumps to only SIBIs. If you start seeing these SIBIs, that's these down close, big, large range candles, you have one here. You see that? And then I'm going to close it. We've had enough time today. And okay, we have the market trade up here. The bodies are pretty much respecting this inefficiency. The wicks go back to this SIBI that acts as an inversion fair value gap. And then we have this nice launch lower, disrupting all these relative equal lows here. We expand down through it, and then we trade back up to it. And it breaks lower. And then what does it do here? It disregards it. So now something has happened down here. So when you're looking at it spread out like it doesn't look so obvious. But when you do something like this, take a step back. This is something I learned from Larry Williams. If you feel like you're losing touch, zoom out or go to a higher time frame and step back away from your charts. Look at it from across the room. And you'll see that this looks very jagged. But when you're zoomed in real tight, it doesn't look jagged. But this is a disruption. And as I mentioned earlier this morning before it went below here, this would be a potential area to look for it to draw down based on any assumptions of this being a reversal pattern as I outlined with the breaker and an inversion fair value gap. But this right here is made jagged. Smooth, made jagged. So what will we do? We look for buy side. Buy side would be this high and this high in here. It trades above it. We don't really have a high to work off here because this is the highest one and it goes down as we go over here. So it's this high here. So this is a potential run on this high here. And that's something you can watch today, the rest of the day, and study that. And then once it does it, if it does it at all, you go back through the price action and you study what was there. And you pull out the points that you understand about what it is I teach: breakers, fair value gaps, institutional order flow entry drills, inversion fair value gaps, mitigation blocks, and the whole thing, everything that you understand about it. And when you do that and you're identifying every single one of them you can see in hindsight, what will happen is because you're collecting these screenshots and you're expressing your observations in your journal, what will happen is your eye will start resonating with one particular entry model. What is an entry model? If you think the price is going to go lower, what is the catalyst that puts you in your trade? That's your multiplier. That's the thing you're betting on panning out. And based on where you're trying to get in at versus where the stop loss should be relative to that trade idea, you're trying to make a multiple greater than one, okay, of whatever you're risking. And it need not be exorbitant. You don't need to have 2 to 1. You don't need to have 3 to 1. You don't need to have 4 to 1. You don't need to have 5 to 1. You just need to be able to see and anticipate fluctuations in price that are reasonable, and it gives you something to study, because the first lesson you need to know is how you're going to interact with that. As soon as it starts moving and it starts being quick about it, even if it only moves 10 handles, you're going to have a surge of adrenaline, and you're not even in a real trade. It's a demo trade. But because you're seeing something that you anticipated and it starts to run in your favor, that sense of accomplishment and satisfaction is very, very addictive, which is the reason why you go in and you push it on the button on the demo. Oh, I'm going to do another trade. That felt good. Let me do it again. Let me do it again. Like someone's scratching your back, okay, or doing something else for you. You don't want to find your happy endings by over trading. That's not good, okay? Your happy ending comes by doing very little and being content with that. That's the secret sauce in trading. Doing very little and being content with it. Everybody else, and I was like this before too. You get a win, or you make money, or you do something right, and that sense of accomplishment, nobody else feels it because it's in your skin that you're experiencing it. And showing somebody a chart or showing someone the move, even if you recorded it, sure, other traders can look at that and nod and think, yeah, that was pretty good. That even if they told you you're the GOAT, it still isn't going to satisfy you, because you want them to feel that elation, that orgasmic experience that you felt because you saw it coming, you executed on it, and then it panned out in your favor, and it delivered with fierce momentum. Like it was real quick and sudden. It was immediate response. Like it listened to you. That's what it feels like. It listened to you like you had it on a leash. You need to quell that. Okay? You need to quell that, because nobody else is going to feel it like you want them to. And you're going to be in a pursuit that always seeks outward confirmation. And by you doing everything in your journal and you being an island unto yourself, that means everything you do, you're in charge of this corporation, this enterprise that you're creating. You're the CEO, you're the CFO, you're the employee, you're the janitor. You got to take the trash out. You see it. And sometimes it's going to stink. You got to clean the toilets. You made that mess. So it goes without saying that you should be focused on trying to keep everything positive, filtering out negativity, and also managing your exuberance, because you don't want it to be a sugar high all the time. Because just like fear can paralyze you and cloud your mind, when you think you can't do anything wrong, that's usually when you are going to fail your worst. Like it says in the Bible, it says, pride goeth before the fall. You don't want to be so high and lofty about yourself in terms of your thoughts about yourself or your ability or your prowess at any time, no matter if you've been doing it for 30 plus years or if you just discover your own routine and then now it feels like a model that you can trust. You have to really keep yourself protected from becoming emotionally stimulated by your ability. and it needs to be boring. It needs to be monotonous. It needs to be like a business. Yeah, sure, I'm going to do all this stuff and that might yield me X amount of dollars if I do it correctly. But you're not focused on that because in the beginning stages, you want this to be so routine and so dry and boring. You can't be emotional about it. It's just making money or managing losses. That's it. You have to reduce it to that. And that's what a business does. They're they're not in the business of worrying about if they're still going to be in business. They're not doing that. They made money with a business model and they stick to it. And what you're doing with this is you're starting your own business model, Caleb. You have to think about it like that. And everybody that you allow to influence you or have an interaction with you, they're all going to tell you something that is ass backwards. You know who I am. You see what I do. You see how we lived. You know everything. I'm your dad. Everybody else's opinion and the horseshit head up their ass perspective, everybody else is talking from ignorance. Okay? You see this. You've watched it. Now you were trying to get serious about it. You want to learn how to do it correctly. Like I promised you, you cannot go quickly through this. And it's going to seem boring. It's going to feel like I don't want to do this part. I just want to get in there and push a button. If I'm right, I'm right. If I'm wrong, I'm wrong. That's what a man thinks. That's a barbarian or gladiator perspective. I need to learn by losing real money or trading with real money. No, you don't, you stupid asshole. That's an asshole's perspective. That's somebody that's a fucking idiot. That's someone that's fucking clueless. And I promise you, they are not making money. And I'm talking about living on your ass, doing whatever the fuck you want to do kind of money. That's a mentorship that doesn't know shit's mentality. I had to learn how to trade with real money, even if it's a small account. That's bullshit. That's bullshit. That's bullshit. And many times it's coming from the mouths of people that don't prove they can do anything. They don't even get out there and call it before it happens, let alone trade it with real money. So you have to guard your mind from all these other people because these people they're going to want to use you as a way of finding significance in themselves. I had to tell Cody, I had to tell Cameron, I had to tell Caleb, I had to tell his youngest son what to do. I had to coach him because ICT, his dad was telling him wrong. I had to put him on point. All of you assholes out there are just wanting to have that opportunity to say something to him like you somehow fixed him or you gave him this little edge. And you all know shit. You know nothing. You absolutely know nothing. You have no accolades, but you want to feel significant because you want to feel like you did something. You made an installment in ICT's son. And that's what you have to guard yourself from on an individual basis. Because as soon as you say you're trying to study what I teach, everybody's going to come at you and tell you why you shouldn't do it. Or it's a complicated thing. No, it's work. It's not an indicator, push a button when it tells you, here, it's a buy or sell, when you don't know what the hell that was all about. What's the logic behind that? Nobody will tell you. Because to do that, they're giving you your proprietary information that creates that black box scenario where it's a flashing Lux algo that does this and does that. What's the methodology behind it? And you're going to trust that versus what your own experience doing something based on time and experience and seeing the fruits of it. The next 4 weeks or so, you have an experiment. It's very easy. And you'll never have to waste any more time, ever. If it doesn't make sense to you, if you can't see it, don't ever expect to learn from me. Don't ever watch my videos. And just, for you, Caleb, just expect that you're going to work the rest of your life. Because this is as simple as it gets. That's it. It's either going to go up or it's going to go down. Why would it go up? It's going to go towards relative equal highs. Or it's going to go down to relative equal lows. And if they're not obvious in the chart, what do? Well, you force a trade. That's what you do. Shit. If you can afford 10 contracts or 15 contracts, you do as much as you can. No, you don't do anything. You sit on your hands, turn the charts off and say, okay, this is not obvious today. It's not obvious. If it's not obvious, why are you risking money? Casinos operate on the basis of it's obvious that people are going to come there with money. It's obvious that the odds are stacked in their favor. It's obvious that people will not quit when they're up, when they're in profit. They will not stop trading, or I'm sorry, they will not they will not stop betting or gambling because the bug bit them. Oh man, I'm up $5,000. I only came here with 250 bucks. Gertrude, hey, we're gonna have a steak dinner tonight, but I'm coming back down afterwards. I feel like I'm gonna make a real big run. Yeah, you're gonna run home, fucking broke, but you had a good steak dinner. If I would have just stopped, right? Here, it's the same thing. You have to know when the odds are in your favor. And when it's so obvious, it's so easy. That's what I'm pointing out the stuff. And I'm telling people, look at this. Look at that. Look at this. I'm not every single day in Tanja's live stream or in Trades by Matt. I'm listening to both of them. It's like background noise until I hear something that's either funny or something that gets my attention or whatever. Or if I'm waiting for a specific trade setup, I'll go to their chat and I'll see if they're in love with something that's opposed to what I'm doing, and then I'll use them as sentiment. Not them particular, the live streamers, but their audience, that they allow for their open discussion of what they think is going to happen. And the more cheerleading they think, or the more backbiting they think for someone else that has an opinion that we be similar to mine, I am much more emboldened by my trade idea because of that very thing. And I don't mean that to be disrespectful, but I've taught this openly. I use social media as a sentiment gauge. And if I have a trade idea or I expect the market to draw to a specific level, and the general public that doesn't think like I teach, they, if they're diametrically opposed to that, to me, I like that's the surest thing there is. Like I have no doubts that it's going to pan out then. And then what do? I share it publicly. I'll go into their chat and I'll say, look at this or note this. And then all of a sudden the people are like, oh, look, it's ICT, he's here. And then the people that are not looking at me like a celebrity and they're like, okay, he just co-signed. Let's watch and see if it goes there. And they're like, damn, he just did it again. Their mind, they understand the plan. They understood the assignment. Oh, ICT just tipped his hand. This is where it's going, guys. But everybody else is talking to me like, hey, ICT, how you doing? Hey, ICT, how you feeling? Hey, ICT, how you doing on the Robbins Cup? Hey, ICT, remember that guy that said this about you, blah, blah, blah? We saw some really interesting things about him. All that stuff is not minding your own business. All that chat, that chatter, that's all wasted time. I'm not reading everybody's comment. I don't have time for that. I'm looking for keywords. If I'm bearish, I want people to talk about being bullish. I'm going long or I'm long this. Man, I love that. I love that. But if I have a trade idea that I'm not all that terribly excited about, where I think it's still in the early stages of developing, and I see so much chatter that's very similar to what I'm expecting, I'm not taking that trade. What? Yeah, I'm not taking that trade. Because if the street money's in alignment with what I'm thinking and it's already a lukewarm idea anyway, eh, uh, I'm going to side on the fact that I'm probably wrong. I'll just stand out. And there's a few times, and it's not many, but it's a few times where I stayed out because of that and it ran without me. And that's okay. I can sleep good with that. What I don't like is if I use them as opposing sentiment. And it's not just these two live streamers. So don't think I'm ganging up on them. I have respect for both of them. I've pushed both their channels. I think they have the moxie to stand out there in front of people. They push the button in front of people. They tell you what their opinions are. Um, it's to me, it's incredible to do because I personally would not do that. I wouldn't do it. Frankly, none of you deserve it. Two, it's just not in my character to do it because I will think about if I'm wrong. Say I'm wrong on this trade. I knew people were putting money behind it. And if I lose, they lost. And I'm going to worry about their money, not mine. Who's in charge of the trade? My emotions. So I can't function that way. It's not that I can't trade. It's just I can't trade with that type of pressure where if I'm wrong and I can take that loss, you might not be in a situation where you can. And you probably over leveraged your funded account, hoping to get your thing passed in one day because I took a trade that made it public. So I worry about those types of things. I don't want that problem of having to worry about that. When I put a trade on, I don't care. It's either going to work or it's not. And I'm devoid of any emotion about it. But if I have other people that can coattail, I don't want that because it becomes a burdensome thing for me. So I say that because I know Caleb wants to potentially grow a channel into something like what I've done with mine. And I'm not trying to talk him out of that, but I did very, very vocally tell him that you have to be content with enough. If he gets his rent paid or half his rent paid with whatever the channel does while he's learning, that's a huge advantage. And that's going to be an encouragement for him to study more to get good at doing this better and eventually replacing his income at his job. Because that's the main goal right now is to match what he earns at his job. And then the next goal is to double that. And then after he can double that consistently, then he has to do 2 years of saving with whatever he earns on that channel and what he earns in trading and what he can save at his job. Once he has 2 years of that salary, then he has my blessing that he can quit his job. But prior to that, he can't. There's no discussion. And if he tries to do it sooner than that, I'm not going to help him because it's irresponsible. You're setting yourself up for failure if you do it any other way. And there's nothing different from what I just said, from what I've said in the past about when you want to quit and trade full time. Because unless you have 2 years of salary and you've had consistently being able to double your income with your trades, you have no business thinking about quitting your job. And I know a lot of people want to do that because, that's the life, but you don't realize when you quit your job, you've made trading harder. You've made it harder because now you have to eat on your results. And that, my friends, is very, very difficult unless you know exactly what you're doing. That means knowing when not to do something and when to do it and when to push it real hard because that circumstance, that environment you're inside of right now, it's really ripe to really be milked and just take it to the limits. But sometimes when we're brand new and we're overzealous about getting in there just to make money, you think that social media influencers, and I'm guilty of this because I can talk somebody into doing something very easily because of the hype that I place around the things that I promote. All my stuff is badass shit. Like it's top tier stuff. There's nothing like it. And when you see it being implemented and explained and it happens, it doesn't do anything except for get you like hopped up on goofballs. You really want to run through a wall. You're like, I'm ready to do this right now. I ain't got time for this ICT. I need to make my bread right now. So the next live stream, whatever you say is going to happen next time, I'm putting money on that one. And if you do that, you're an idiot because you're going to feel emotions, physical stimuli in your body. You're going to feel adrenaline, and that's going to increase your heart rate. And then you're going to start feeling that rush. And then you might think about, oh man, my hands are tingling. I feel a little excited. I feel like I'm seeing stars. And that's cortisol. And that's the stress hormone, which literally will tear you down. You keep doing that. And then you're going to start worrying about what you feel like versus what's the price action doing right now. And then I got to walk away from the charts. I gotta just take a walk real quick. And if you smoke, which you shouldn't do, I got to go get a smoke. I got to go vape and stick the shit in my head and puff on that. Are you in control of yourself? No. Are you in control of your trade? No. Are you managing everything soberly? No. But you're trying to make money. And it's all the wrong way. That's all the wrong way. When you feel like you have lost the plot or you can't see it, son, don't feel obligated to tell me what you think's going to happen. Be comfortable saying, I don't know today, or right now, I don't know. And there's nothing to be ashamed of in that. I'll be more proud of seeing you do that than trying to tell me when I know with experience this is dog shit. It's not going to do anything. It's just going to be a mess. It's going to be unorganized, and it's going to do a whole lot of unfulfilled delivery of price. That means it's just chopping around and moving around without any real rhyme or reason. Because it can stay in a range, a defined range, and do nothing extra outside of that. And I don't want to be involved in an opportunity like that. I want to have where it's easy to run to a range low. What range is that? Well, it could be the range of the 7 o'clock to 8 o'clock hour. It could be the range of whatever the highest high and the lowest low since 9 o'clock, or at the opening at 9:30. All these ranges have the potential for you to have your own unique model. And once it trades to them, you get out. You're not trying to get 100 handles every day. But some of you think that's what you should be doing. I got to make 200 handles a week or I'm not killing it. Really? I have students that have one contract trades. They never do more than one contract. And they're doing $20,000 a month. Month after month after month after month. And they still keep their job. They still have their insurance. They're not trying to impress me with, I'm trading 2 contracts now. They're like, I don't need to change anything. This is good. You know what that is? That's maturity. And I fucking love that. I love that because that's someone that listened. That's someone that did the personal inventory on how they interact. How do they engage price action? How do they work within the constraints of being in a state of not knowing for sure what's going to happen, managing themselves, following the processes and protocols, and just submitting themselves to the process and being content with enough. 20 grand a month. Do you earn that at your job? Chances are, no, you don't. I promise you, most trading influencers on social media don't make that in their trades. Mm-hmm. And I'm certain she could do a whole lot more. Well, I shouldn't have said that. Well, they can do a whole lot more than that. I'm convinced that they could because they only take one setup a day. They have a one trick pony mindset. They're not trying to bring every ICT bell and whistle into the conversation. They wait for one simple little thing. And when it happens, they take the trade. They have their stop loss. It's reasonable all the time. And then bang. Once it trades to a high or a low that they know liquidity is resting at, they're done for the day. And it doesn't matter to them when it has these big range days. How about having something like that as a mindset initially? Not that you have to aim for $20,000 or you're not successful. If you just make 1/4 of your income a week and you lose 4 times out of 5 trades, but you were still able to net that, is that failure? Some of you on social media would see that that's failure. It's not. When you are brand new, you better expect to have those types of results as a first rung objective or goal because you're going to flounder in the beginning. You're going to feel like you don't have what it takes. And you're going to look at days where it's challenging technically. You know, there's days where the market may appear it's going to do so obvious. It's going to go here or go there. And I'll get tripped up in that. I'm human. I might come into it with a case of the ass. I'm mad about something that happened. A guy cut me off the other day on the road and I'm still pissed off about it. You know, I'm trying to exact revenge on this guy. I'll show him. He doesn't even think about me now. And that's what we do as humans. We bring in all of our mental baggage and we want to have a triumph that reminds us that we're more than what everybody else thinks of us or what we think of ourselves the previous day. What do you think it's doing here? Just like we had over here, we had a disruption. We have a disruption down here. So where is their relative equal highs? Here and here. So what are we looking for? We want to see if it can muster the ability to poke its head above high of the day over here. I hate when it does that. Always jumps the last second. I gotta adjust it. So We have inefficiency here. This could be an immediate rebalance. Immediate rebalance is when you have a extended range or a candle that goes up and then it drops back down and just touches the candle high and then starts to run to an objective or liquidity or an efficiency, something like that. We also have this fair value gap here. In this case, I'd like to see this fair value gap stay open, not traded entirely down into that candle's high, and then reach up here. So these are all little drills and exercises you can do that will eventually lead to trade entries and trade stop placement and management. But more specifically, it teaches you expectation, anticipatory price reading, where you study charts real time and you're watching price. It has to be on a real time basis. It can't be a market replay because market replay is like stilted. It's like wooden. It's stunted. It doesn't have the fluidity that a real time candlestick has, where you see the candle. Like for instance, these are 1 minute candlesticks, so they can be seen where at one time it could be looking very much like it's going to be a down close candle, and all of a sudden it flips and goes the other direction. That's a dynamic, fluid environment. You want to be able to see price action. If you think you're going to trade well and consistently without having that exposure to price, like you can't skip that part and be good. I promise you, it doesn't work. Nobody ever gets consistently profitable without doing some measure of forward testing and back testing. It may be minuscule for some that are very, very gifted, but it's usually failure without doing it. And when you start understanding the things that I'm outlining, you'll see that there's plenty of opportunities. There's so many opportunities that are there all day long, but because you have painted yourself into a corner, you think that there's no way that I'm going to be profitable unless I get the big run of the day. So I'm going to start hunting just for the big run of the day. And you might miss the ideal entry point, which that gives me, I guess, the perfect opportunity to use that 15-second chart, because a lot of you were thinking earlier when I said, we're going to say this and quit. Because this is supposed to be a short one, right? I'll use this as an opportunity to go into the 15-second chart in a second. I promise I won't close the live stream until I do that part, because I did mention it earlier. But one of the key takeaways by doing this mentorship with you is I'm teaching you, son, to look at price with these little tiny little pieces of repeating phenomena. And they happen at specific times of the day. They happen at a measure of frequency that is sustainable. It is going to repeat weeks and months and years in advance. As long as there's a market, these things will manifest. They will repeat over and over and over again. All of them will not be profitable. The majority of them tend to be. Okay, so I'm setting your expectations and trying to calibrate your expectations to a degree that you should not be expecting perfection. Okay, that's something that should be first and foremost. Don't expect perfection. Don't expect everything that you do to be without pain. It's going to be hard, especially in the beginning, where you feel like, I have the best of the best. Dad's giving me the best of the best. So therefore, I should have no expectations for adversity. It's going to be really, really hard because you don't know the outcome. And as much as you might want to dismiss it psychologically and say, I have the best of the best, you still have to endure the waiting of this to pan out. And you still have to go through the process of developing, like the rest of my students. There's nothing that you're going to be subjected to that puts you at the front of the line. There's no shortcuts around this part. This is the stuff that every single profitable trader does. And this is what they do to make that money. They got to be in front of the charts. They got to submit themselves to the idea. When they co-sign and say, okay, I'm going to assume a trade and take on that responsibility and risk, they have to agree on, if they are wrong, this is what they have to lose. And why compound that by saying, I'm taking a trade into the ether, saying I'm going long or I'm going short, and this is where my stop loss is, for the sake of being able to say you did it, when you don't know what you're doing yet, or even when you first find profitability. Young men tend to want to do that because it's like the gladiator scenario where they want to do something to impress everyone. Making money, it wasn't enough for them. Being profitable wasn't enough for them. They want to be lifted up on a pedestal and say, you are a goat. And that's a sign and character flaw that is synonymous with men, usually young men. And I don't want you to grow into that. I want you to be humble. I want you to be modest. I want you to feel like you're blessed. If God gives you your understanding to this, and I'm praying that He gives it to you, um, when this is something that you can do on a consistent basis, you shouldn't go around like a sharp stick and beat everybody over the head and say, you're inferior because this is what my pedigree is this, and I can do this because I learned this way of doing it. Number one, it's ugly. I won't be proud of you for doing that. I don't think you would do that, but I say that because I know other people are listening, and they might have that as an aspiration. For I want to do this because I want to be significant in the industry. I want to make a name for myself for the sake of clout. And the best measuring stick is being content with what you did, how you did it. You didn't hurt anybody. You didn't belittle anybody. You didn't try to measure yourself up against anyone else. And you don't concern yourself with those types of things. When you trade and live your life like that, you will have no drama. You'll have no spirit of competition that you have to live up to. You don't owe anybody anything. You don't owe dad any explanations for how you're doing it. You don't know anybody on social media an explanation of how you're doing. You have no reason to give anybody a testimony or update of where you are and how you're doing. But if you choose to do that, do it tactfully. Do it in a manner where it's disarming. You're not trying to make anybody else feel like they're inferior. You're not looking at anyone trying to say, I'm better at you. I'm better at this than you, or I'm going to be faster in profitability. Because I guarantee you there's lots of students out there right now that are going to try to race to consistently profitable with you. And that's a terrible, terrible thing to do because it's not a competition. It may take you longer than you already think it may take. And I want you to know as your dad, it's okay. It's okay. There's no rush. I'm not going to ever run out of interest in trying to help you. This is what I've lived for. I've wanted you to do this. And here you go. It pans out. That was a immediate rebalance. Immediate rebalance is here. It trades down, touches the candle, rallies up, and then we have a order block. It trades down into that and then expands up to there. So if you did something like that where I don't know now. I forgot where the what candles because I was so interested in talking, but nonetheless it delivered where we thought it would go. I said I wanted to see this stay open here because that would act as a breakaway gap, and then this should have been the immediate rebalance there. And then the next candle is it rallies up, and then it's trading back down into this down close candle, which is an order block. It rallies up, it completely closes in this inefficiency. One more time, taps into it there, and then finally reaches up. I would absolutely be done. I wouldn't touch anything the rest of the day. There wouldn't be anything else I'd be interested in. And it could have all kinds of excitement right now. I wouldn't touch anything more. Why? Because we have traded down. We had a disruption, took out the sell side. After we had a disruption here, and then we've come back and touched the high of the day. So I wouldn't want to worry about trading in the afternoon. I wouldn't worry about doing anything. I would be content with whatever it is that you've done, whatever you've collected today in terms of insight, experience, logging, encouragement, whatever that is, okay, it would be content and left right where it is right now. But I want to drop down into a 15-second and kind of tell you what I was talking about as we started this live stream. Let me go down into the 15-second chart. Let's highlight this first. All right, and then we'll make that green so it's It's highlighting. So here's the 5-minute price run in here, okay? And this is the immediate rebalance right there. So I'm going to draw a little line on that. And as you see, everything I'm doing here, it's highlighting it. It's highlighting it on the 15-second chart. Okay. And now we can take our attention over here. So I annotated everything that I was talking about and expecting on the 1-minute chart real time with you. And now we're inside this price run. So I'm going to talk about, and what I mentioned to my private mentorship the other day, this is the price delivery continuum theory, where you have an expectation where price is going to gravitate to, and it gives you a continuous opportunity for you to be a participant in it, because the markets are fractal. They're going to offer you setups on one time frame, and then that time frame has, once it's expired all of its opportunities that's used for an entry mechanism, you can't do anything else unless you're going to just chase price. I don't chase price. Okay, I'm going to show you how you can effectively and efficiently use a 15-second chart. Should you ever want to do so, you don't have to, okay, but you're going to find that it is very forgiving for traders that have missed an ideal entry. And or wants to, I'm going to say this, but please do not take this as an invitation to start doing it yet, because pyramiding and adding to a trade that's winning, that is very, very challenging for me as a mentor to teach that, because I already know that you want to do as much as you can to make money as fast as you can. You see all these people out here that have 15, 16, 20 accounts, and they're doing lots of withdrawals, pretty sizable withdrawals from trading all that. And it's important for you to be comfortable being consistent with small trades in the beginning, because if you can be consistent making small trades, you're building the mindset, you're building the the skill set, really. That's the best way of saying it, to adhere to rules and not chase extra money. And you're going to want to do bigger trades all the time, especially if you start sharing your results with people on social media, because the novelty will wear off fast. You know, when you buy a really nice sports car, everybody around you, your friends and your neighbors, they're like, "Oh, wow, that's really nice." 5 weeks later, they might look at you as you go down the road, but they're not saying, that only happens the first time. Everything's got a novelty aspect to it. Everything wears away. And when you start being profitable, if those trades are, by most of the industry's expectations, $1,000 a week, that's awesome. I'm a millionaire, and I'm telling you now, if you can make $1,000 a week trading, you're doing really good. There's nothing to be ashamed of. That's actually something to be very, very proud of. But what happens if you can only make $200 right now, or in the first 3 or 4 months of you trying to do this? That's not failure. Failure is, I'm quitting and I'm never going to put more effort into this. That's bad. So you have to lower your expectation. But anyway, as I was showing on the 1-minute chart, it was likely to come back down and touch the top of the candle and then start to expand up into this blue level. Okay, that was the initial high of the day, right at 7 o'clock in the morning, using the morning session. And if you look at what was happening here, it traded up and then came right back down. See that? What is occurring there? What's occurring here? It's coming right back down, and it's rebalancing the inefficiency of this quick sudden price run from this close to that close. That's what's occurring. So what the algorithm does, it refers back to that price point at that time, and this is what goes on. The market algorithm starts from a higher time frame and refers to key price points that are salient to where it's at right now. At given sets of time, as I'm teaching you here, it will refer to close proximity points of reference, and that means things like this, where we have a quick sudden run like this in a 15-second chart, in a 5-second chart, a 1-second chart, It's cycling through very, very fast. The mechanism this it's going through all these calculations so fast you can't keep up with what's actually going on. So when I had to sit down and create a language to try to compare and contrast the closest thing I can and not break any agreements, this is what you have. You have this visual representation of it, where it's likely to draw to this level and just above it. It comes back down, and where there's an absence of a fair offer for buying on a down tick. Okay, you ever hear how like when the circuit breakers go off on the the market where it goes too far one direction, there's a circuit breaker, they halt trading. Say for instance the market goes down too fast, too much at one time, and they pause trading until the market starts to tick up. Okay, there's a lot of high frequency trading algorithms that operate and engage in the marketplace like that. So they're filtering out of, they're not trying to buy when the market's expanding up. But what their algorithm seeks is these inefficiencies here. And then once they get inside that range, once it meets that threshold of trading into it, then once that's met, then it trades the first down tick after that. And then their algorithm fires entry orders to get long, knowing that the algorithm is repricing here. You can, if you have the benefit of looking at time and sales, you can look at how many contracts were traded here from here. That's not a lot of contracts. That's not a lot of contracts from here to there. It doesn't take a lot of contracts to move price. It just needs one contract to book and show time of sales. It's not volume that's moving price. Volume precedes price. That's a textbook right out of every retail language book there is. Volume precedes price. What does that mean? There's going to be a lot of volume in this area down here. Why? Because it took stops out. What's below here? Sell stops. So volume will be larger here than it will be in here. Because this is all discovery. This is all going to levels that are outside the range. And while there might be buy stops above this blue line that I indicated, the further above that line we get, the less volume there will be, because everybody wants to have a stop loss real close to a level. And it's thinner as it gets up here. And that's why you start to see the price start having all these big gaps, because it's pressing higher and higher and higher. The algorithm is just going to reprice higher. Whether you want to be a buyer or everybody collectively wants to be a buyer or not, it's programmed to keep offering that price, because someone is always coming in with a sell order at market and a buy order at market. And guess what that does? It gives you the counterparty, and it's going to book price. You can sit on your hands and talk about how you're not going to buy it because it's this, that, and the other thing. There's always some market orders coming in. Always. And the algorithm knows that that function of liquidity is always present. So it will constantly offer higher prices, and it doesn't matter how many Tom, Dicks, and Harrys from Goldman Sachs, okay, or, well, I like kicking them around. We'll just leave it at that. All these large investment firms, no matter how much volume they got or they're trying to push into the marketplace, they're not pressing price down. They might gloat and say, yeah, we did this, we did that, but they're not doing shit. They're stuck in the same delivery paradigm that every one of us is too. The market's going to go where they're going to go, regardless of how much buying and selling pressure there is. Period. End of story. And the common equation, or not equation, but analogy I like to use is, when there's a limit up move in the marketplace, how many contracts does it take to cause the market to open up, limit up? Say you're trading silver, and the markets are closed, and then we open up, limit up. How many contracts does it take to cause that trade to be lock, limit up? Just one contract, because it's price oriented. But it opened at a time when that first price was offered at the furthest extreme that the exchanges will allow, and that means that you have a limit up move. So buying and selling pressure is not it, okay? It's time and price. So in here, we have price dropping down to overlap this inefficiency. There's no gap in here, is there? Is there any gap in here? Sure there is. Look. I'm not Chris Laurie. When there's a inefficiency, if it comes down and closes it in, I'm not done with it. Relative equal highs. Here, fair value gap. It trades outside of it, comes back down into it here with a 1 minute immediate rebalance. So it's trading down to a deeper discount. So this is your first return in after taking the buy side here, but this is left intact. So this is still in play. So it's dropping down. That right there would have been a 15-second long for me. If I would have been buying down in here, or if I was long here, this would be another area where I could go long and add another partial. But it couldn't be larger than one contract. Why? Because we're long in the tooth with the price run, and my limit order would be just above here. It wouldn't be up here. Oh, ICT, you should have been looking for something like that. But why? The low-hanging fruit is just above here. That's all I want. That's where the largest degree of volume is going to be, because the order is going to be closer to the levels that are expected. The algorithm is going to reprice because it's going to do the function of what a wick does, where it does the damage. It colors outside the line, just like your son or daughter will. And she's doing exactly what she's coded to do. But I need to be efficient with executions and remove the element of fear and greed and regret. So I'm going to take where it's obvious for me to get out. If you start getting out at the highest high and getting in at the lowest low all the time, you're going to experience broker problems. They're going to slip you. They're going to do requotes and you're going to miss. Because if they've been B-booking you, and you'll know they've been B-booking you if you start getting that kind of stuff and you're winning, then they'll start messing with you because you're taking money out of their hands. You can get mad about it all you want. Oh, it's wrong. It doesn't matter. You gave them permission when you signed up. It's the way it is. If they can get you out with the liquidity, then they will, but they can't guarantee it. So there's their gray area. So the 15-second chart, when you see things on a 1 minute or 5 minute chart, it gives you opportunity for you to get in alignment. Now, let's just say for sake of argument, when I was calling the 1 minute 1 minute immediate rebalance and expecting it to run up here. Okay, that is a 40 handle run or more. The live streamers on YouTube, most of them don't see that. They get out with like 5 handles, 15 handles, 10. They might say they're aiming for 20 and they get out at whatever their emotions push them out of the market with. And you never really see them enter. You don't see when they're actually telling you this is where it's happening right now. They have a target that's a lofty one. They'll say, I think it's going to go up here. And then they'll say, well, see, I called it. Who's doing it like us? And they show you the trade after the fact. They do that because they don't do what I'm teaching you to do right here. And they're going to start doing it. Trust me. And then when they do it, their trading will improve and they'll get more confident about pushing the button at the execution points from beginning to end. And then they can earn the title of #1 day trader on YouTube. But until they do that, they can't. So let's say I missed this opportunity to be long there. Okay. We have a down close candle inside of a fair value gap that came back down into an old inefficiency as well after the first run above here. This is all extra credit stuff. Okay, so this is more or less not for you, Caleb. It's for the people that are familiar with my stuff but just want a little bit more icing on the cake. When it trades back down into this down close candle here, that could be a buy for me as well. That one, and we can look at this little gap right there. See that? That's all it takes. It trades down to here. My limit order would be just above midpoint of that wick. I'm not demanding it gets me filled in there because I may not get it. So I'll be a little bit more forgiving in placing a limit order there. And then I could use that to get in sync with the run if I felt like it was going to go higher. I'm just teaching on the basis of how to use the 15-second chart and how it gives you a plethora of entries. There's so many entries offered on a 5-second and a 15-second chart that you don't see in a 1-minute chart. But the algorithm's doing the same thing. You're telling me that people are looking at the chart and they're looking at reference points that I've classically defined now as PD arrays. The market keeps going back to these price points. You mean to tell me everybody that learned from Online Trade Academy and supply and demand that they're all looking at 15-second charts and they're stopping the market right at these levels? Their buying is stopping it right at those levels and it's keying off of that stuff precisely? You're full of shit. It ain't happening, Jack. It's all algorithmic. And it doesn't matter how many buying and selling of specific number of contracts, the price is going to go where it's going to go because it's scripted. And it's going to go there based on time. That's the way it works. And you can argue with me, and I don't care. You're never going to convince me otherwise because I'm out here doing it. I'm out here telling you what it's going to do beforehand. You're going to argue it in a hindsight capacity. If you want to have a session where we sit down together and you're going to explain things retail, I would love that. I would love that. I will do a live stream and they could be on one side of the screen and we can take turns talking about what we think is going to happen. And I will run circles around you. I will literally lay down every single price move all day long. But they'll have nothing to say then. They won't. But other people will still say, well, that was just one day. That was just, he got lucky. it's fun. It's really fun. But anyway, the 15-second chart affords you that as a mechanism, okay? It also gives you the ability to reduce your stop loss, okay? Make it a little bit tighter. Not that you should be trading with really early small stop losses in the beginning because it's important for you to read price appropriately and effectively and efficiently first. And then eventually, when you're into the part of taking trades where you have to manage real risk and real money, then these types of conversations are much more pertinent to the discussion. But right now, it's so outside the scope of what Caleb needs right now. It's not important at all. It's absolutely zero importance, zero. But I wanted to kind of like outline something real time and give you a feel for how you can make bread and butter setups. And they're real easy to see. Like if you understand where the draw is, what it's done, it made something jagged down here, and it made something jagged down here, and it left that high and this high in place. It's relatively equal. When you have the chart spread out like this, it doesn't look like that, but when you compress it, we're back in the same discussion of, okay, it failed to get back to that one. So the second one was lower. So what does that mean? It's a high probability relative equal high. The market will reprice to that because it wants to disrupt. It wants to disrupt. It wants to be that cousin or in-law that comes to the cookout that you really don't want there. That's what the market does, okay? And when you understand that, you'll do better in your trades. But I've gone on and on today. I've really overstayed my welcome. I'm tired, I'm hungry, and I want to get off here. So hopefully you found this one insightful. If you did, I would appreciate a thumbs up. It doesn't mean you love me. It just means that you learned something today, and you're continuously getting a deposit in your understanding. And that's like a report card for me to either continue or not. If there's 100,000 people watching and there's less than 17,000, that's going to be very discouraging. I might take tomorrow off if that's the case. So let that be a little factor in whether or not you want to give me feedback. Until I talk to you next time, be safe.